anyone would have had it anywhere close to where it is right now. So the Fed is going to be concerned that its rate-cutting intention is misperceived. And, you know, it's very difficult. And I think what might help is when the Fed starts talking about the long-run interest rate, which the Fed still has pegged at 2.5% in its SEPs, they either get rid of it and say, hey, we don't know where it is, or they adjust it more to where markets are currently priced.
To get back down to 2%, because again, as you say, that is what the Fed has pegged it at. Mohamed El-Erian has been writing about this, that you would need to see serious damage in the economy, and therefore it's not worth actually trying to get back down to target. Is he right?
I actually, while having great respect for my, we were both at Cambridge University pretty much at the same time back in the late 1970s, well, I actually respect him. I think he's wrong on this one. I think what the data have shown so far is that you can have disinflation without destroying the economy. And it is absolutely worth squeezing inflation out for that last mile. And it doesn't have to be a quick disinflation. It can unfold over time. But again, it comes back to the Fed saying, giving an important speech that's saying, hey, this is how we see monetary policy working. And this is, I believe the Fed is absolutely intent on getting inflation back to 2%. And this is how we're going to do it.
Well, some folks have said that it's some signs of slowing in the consumer that turn into cracks, that turn into something worse, that brings inflation back down. When you have reports from individual companies, Starbucks, McDonald's, saying consumers are starting to be worried, how much stock do you take of that, especially heading in to, again, tomorrow, Wednesday, when we're going to be getting some of those retail data coming in, and then we're going to be getting earnings from the likes of Walmart and Home Depot?
Well, we get the retail sales report on Wednesday, on Thursday, and you know that can be pretty important release. But the consumer has seen their savings rate fall. We're now at a savings rate down at 3.2%. That's actually relatively low by the recent history, but consumers also still have a massive amount of wealth in relation to income. So, you know, we're in relatively uncharted territory because apart from when spending was shut down and people were getting income injections from the government, and so the savings, up to $2.5 trillion of unintended savings accumulated during the pandemic. Apart from that, we've never had wealth in relation to income at this high a level. So it's very hard to go back and you'll be relying on models that have not actually experienced where the data currently are. But in the end, when it comes to the fate of the economy, it's not about the consumer. It's about whether companies make money and then hire people and then invest. And that's the dynamic process. Then they hire people, people get wage income, and then they spend that wage income. So for us, changing our recession call and taking the recession out of the central case for this year was not about the consumer, the consumer's doing very well. It was about companies where we haven't seen that squeeze in profits as inflation has come down. So we've had what economists, and I thought was skeptical could happen, was this immaculate disinflation where inflation's come down, but we haven't seen profit squeezed, and we haven't seen the economy pushed into even a sharp slowdown, let alone recession.
John, perhaps just a touch of heresy to say it's not about the consumer, but it's good to get that view. John, thank you so much for joining. I'm afraid that's all we have time for. That is John Writing of Green Capital. Lisa, and again, I think this idea that John was talking about is fascinating, that the Fed needs to be making clear that this is not a typical rate-cutting cycle. It's more of an adjustment to get the restrictiveness of policy back in line with what inflation's doing.
Insurance cuts, something like cosmetic cuts, things of this nature. Bloomberg's Danny Ryder, a wonderful interview with John Writing of Green Capital. Thank you. Coming up next, we have Troy Gajewski of FS Investments, Bloomberg's Mario Parker, NYSE President, New York Stock Exchange President Lynn Martin, and James Athey of Marlboro Investment Management. From Washington, D.C., from New York, from Paris, you're watching Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The Fed will likely move once, maybe twice this year, and obviously that has to be later in the year.
I think they go at least once. I think 2 is a good baseline, and I think there's an option for 3 if we're right about how quickly inflation slows.
They're still very much focused on eventual policy easing.
They'll move if the data warrants it, meaning that there needs to be a shock in much weaker data.
I think they'll take out some insurance cuts, which will elongate the recovery that we're in, and that will ultimately set up this bull market to last for years to come.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Heading into an important week for inflation. From Washington, D.C., for our audience worldwide, good morning. This is Bloomberg Surveillance. I'm Lisa Abramowitz. Anne-Marie is off to do that interview with Janet Yellen. John Farrow in Paris. Danny Berger in New York. We have a massive week coming up of key inflation data, starting tomorrow with PPI, that factory input prices. Also, Fed Chair Jay Powell is going to be speaking. But Wednesday really is the key day where we get a 1-2 punch of both the CPI print, the latest reading on just how fast consumer prices are increasing, plus retail sales. How much is this diminishing the consumer's ability to spend? The expectation is inflation's going to remain stickier than the Fed would like, but retail sales, while declining, should hang in there. We will get that check. We'll also get that check with a host of earnings, including from Walmart. And then throughout the week, we get a sense of initial jobless claims, which came in higher than all previous expectations last week, suddenly having something that is something that we're actually focused on. How much of a noisy report was that? Right now in markets, you could see trying to add to 3 straight weeks of gains, which has been the greatest, this longest increase going back to the beginning of February. Just a little bit of a gain, just climbing as the session grows older, up about 15 basis points, 52, 54. The dollar just strengthening a touch. We have seen that, although really curious overnight with the Japanese yen strengthening on the heels of government officials not buying back as many bonds as people previously expected. Yields very much in focus, and this goes to the reaction function of how does the Federal Reserve deal with the idea of inflation that remains stickier than many people are hoping for, even while growth starts to slow down. Crude very much a wild card also, as we have that 13 million barrels a day being produced in the U.S., but a lot of geopolitical concerns and noise about how OPEC Plus will be responding. We are scattered all over the world today. We have Anne-Marie and myself in Washington, D.C. We have John Farrow in Paris to do some key interviews, including David Solomon, the president and CEO of Goldman Sachs, chair and CEO. We also have Janet Yellen coming up with our very own Anne-Marie Herdern, U.S. Treasury Secretary, and Emmanuel Macron, don't miss that, the president of France, who is being lobbied by everyone far and wide, whether it's bank executives or Xi Jinping of China last week. And we will have that sit down with John Micklethwaite, our own head of Bloomberg News. Coming up this hour, we're going to be speaking with Troy Gajewski of FS Investments, and we're going to get to that in 1 second. But Danny Berger down in New York, and I'm wondering how important it is to get a sense of the latest inflation read and how that informs a narrative that has been flipping and flopping. We have gone from no landing to Goldilocks to now we're talking about either stagflation or hard landing. What is the point of Wednesday and why it's so pivotal?
Which, by the way, it could flip-flop again, Lisa, depending on how retail sales come out after that, and then could flip-flop again depending on how Walmart and Home Depot do in their earnings. But it's important for this bond market. This is the stat from Liz McCormick that made sense intellectually, but still shocked me. Of the 60 basis points moves we've seen in treasuries this year, Lisa, half of them have come from CPI days, because we haven't been set up for the idea that inflation would be higher. We got one data point. We said that was one. We got a few more. We said it was a month. We got a few more. We said it was just a quarter of a blip. Is it still a blip, Lisa? Can we say that when we've had the entire first quarter of hot readings? Wednesday's going to go a long way to show us that.
And then at what point does the Fed change the bar? And this is something else that we've been talking about, given the fact that you see, for example, from Austin Goolsbee of the Chicago Fed coming out over the last couple of days talking about how, well, it's going to be sticky because, frankly, rents take a long time to go down, and that's going to be lagging behind some of these forward indicators like consumer sentiment. So we will find out the reaction function. How much is this Federal Reserve willing to look past some of these harder than expected inflation reads in order to get a sense of just whether they need to prioritize growth or whether they need to prioritize fighting inflation. We've got more on that coming up. Danny, cannot wait to get to it. Coming up this hour, we've got Troy Gajewski of FS Investments with stocks coming off 3 weeks of gains. The NYSE president, Lynn Martin, will be speaking with Danny Berger on the potential for 24/7 trading. I'm sure a lot of people are looking forward to not having evenings or weekends, although it's not like many people have full free time anyway. And James Athey of Marlboro Investment Management with a look at PPI and CPI on deck. Let's begin with our top story. Stocks holding steady ahead of a key week of economic data. Troy Gajewski of FS Investments writing this. We're in an interesting transition period for the economy as the labor market continues to evolve from previously white hot to red hot to closer to warm. Troy joins us now. Troy, can we just get a sense, and thank you for joining us, of why we're having such a difficult time reading this when it's clear that consumers are running out of savings, they're pushing back more against higher prices, they're being more selective. So it is something that shows slowing. How do we know exactly how much they're slowing down?
Well, I think to start with, you always have to analyze any investment strategy from a standpoint of sensitivity to outcomes. So, you shouldn't be dependent upon whether the Fed has to keep rates high throughout this year or cut 3 or 4 times for a successful outcome. But to your point, I think the reason for the flip-flopping you were discussing before is so many of the economic models are maybe a little overly fixated on financial conditions. And that's why when financial conditions tightened so much in 2022, a lot of the probabilities that those models were spitting out were close to 100% recession probability when the consumer was still in incredibly good shape and the labor market was white hot. And then we got to a situation where recently where financial conditions loosened as much as they had. And then many came out and said there's really no chance the Fed cuts at all this year. And our point is that, we've been steadily transitioning from this white hot labor market to then a red hot labor market to right about warm right now, whether you look at JOLTS, initial claims that have come up recently and the recent non-farm payroll report. So there is progress, but at the same time, super core inflation, owner equivalent rents have been very, very sticky, which means the Fed is going to be very patient with their cutting cycle.
Are they, Troy? I mean, this is one of the key questions. Can they be patient with a cutting cycle at a time where that might be a lagging indicator? And some of the forward-leading indicators point to what we've seen traditionally during downturns, which is the labor market doesn't turn slowly. It doesn't sort of have this gradual progression, but it's all of a sudden, and it's a sharp decline in the ability of people to get jobs.
Yeah, no, it's a great point. Great question, Lisa. I think, saying this time's different is obviously very dangerous, but clearly, the path that we've gotten here is very different than previous cyclical downturns. And again, we have been steadily transitioning, whether you look at JOLTS, whether you look at initial claims, whether you look at NFP. And when you think about what it would take to really drive a meaningful enough surge in unemployment, it would really take corporate profitability dropping dramatically. And yes, there are some debt service coverage ratios in certain floating rate issuers out there. And yes, interest expense has gone up enough. But corporate profit margins have re-expanded back to record highs. And then you look at other contributors to GDP, whether it's state and local government spending, whether it's business fixed investment. It's very difficult to find one of those subsectors of growth that could roll over enough to cause that sudden surge. So, our whole point this whole cycle is it's going to be the mirror image of the 15 to 18 hiking cycle. The Fed is going to be very patient, and we don't see any data to indicate that they're suddenly going to have to cut by 4 or 5 times by the end of the year at this stage.
It's really well how you frame that, and I'm glad that you did. And this has sort of been the conundrum where you see a lot of lack of confidence among Main Street, but on Wall Street, things look great. And companies have been able to hang in there, and they've been able to deal with lower consumer spending by just raising prices. And they can actually get away with it because people have enough money and they have jobs so they can continue to spend. At what point, though, is there a flashing red signal that you have to take from small caps? When you take a look at that, and that's been in recession for a long time, tried to recover, gotten beaten down, and lagged behind until there's this hope of maybe sooner rate cuts. There is a question here. How much of a probability do you price in of a hard landing at this point?
A hard landing? Yeah, so you can never exclude it completely, but when most people define hard landing, that means, in our view, somewhere between 1% and 2% GDP contraction. And again, to your point, and I'm glad you brought it up, the consumer is in a weaker situation today than a year ago when, there was far more excess savings left. The labor market at that point was somewhere between white, hot, and red. And as one of your guests brought up earlier today, savings rates have run down to the low 3%. So there's less shock absorption capability. But the probability of a hard landing where the Fed has to cut, 100, 200, 300 basis points in response, at this stage, the only thing that would cause that would be some type of exogenous or endogenous shock. And, when you think of endogenous, it would be some type of treasury market accident. When you think of exogenous, it could be geopolitical or another type of pandemic situation. But again, there's nothing clear that says, hey, suddenly states and local municipalities are going to have to cut spending by 5%. Or, oh my goodness, you look at business fixed investment, corporate profitability is at record highs. You have this massive AI boom. Suddenly they're going to cut business fixed investment by 10 or 15%. For what reason? So very, very unlikely. Not a 0% probability, but let's call it 10% or lower at this point, Lisa.
Troy, I know that given all of this, you've been pretty positive on stocks. You've been considering that there's going to be this sort of stickiness to rates where they are, given the fact that the Fed is unlikely to cut. I know you've liked agency mortgage-backed securities. You did just add a trade, and that is the consolidation of small and regional banks. Why is now the time to start thinking about that, given all the questions around what's going to be allowed? What has changed for you?
Yeah, so great question. When you think of the past of the banking system, right, a lot of people forget we have close to 10,000 fewer banks today than we did back in 1990. So you've had, this mega trend of bank consolidation. But within that, there have been periods of very tepid consolidation, and then there have been periods of massive consolidation like the late 90s, like the follow-on from the global financial crisis. And you know, what we're seeing today, you know, in our multi-strategy fund, which again is solving for consistent returns with low beta, low duration, and low volatility, is that because of the regulatory pressure on regional and community banks to clean up balance sheets, and because operating costs have gotten more and more expensive, we'd expect a mini bump in consolidation in regional community banks, not to get to the point where regulatory scrutiny becomes overly burdensome, but to the point where you can squeeze out operating efficiencies. So, you know, that is a beta neutral expression. You know, there's a basket of 20 to 25 smaller banks that we expect to potentially be taken out. And then we take out the beta, basically using the KRE to neutralize it. So if there is some type of shock that you talked about, you know, the downside is very, very limited. So, you know, the next 6, 12, 18 months, regardless of political outcomes, we expect consolidation to continue. And then if there's a transition in DC, perhaps there could be even more heightened activity.
In other words, you're saying that if Donald Trump is elected, you think that that could actually increase mergers and acquisitions across the board?
Well, I think if you look at M&A broadly, the FTC has been pushing back very hard, as you know. That strategy right now is basically pricing in 20 to 25% of deals breaking, when historically it's only been 5 to 10. And it's very clear because we've had a very aggressive FTC. You know, if there is some type of political transition, perhaps the FTC is less aggressive on that front, and that would lead to more consolidation like we saw during the first term of the Trump administration.
Troy Gayeski of FS Investments, thank you so much for being with us. As always, great to get your insights. Right now, let's get an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakez. Yahira.
Hi, Lisa. U.S. Secretary of State Antony Blinken issuing a warning saying Israel risks fueling a Hamas insurgency in post-war Gaza. He cautioned that there will still be thousands of armed militants in the area, even if Israel invades the city of Rafah. The Israeli military estimates that over the past week, 300,000 people have fled Rafah in southern Gaza, which was once a haven from Israeli bombardments in the north. President Biden is set to announce heavy new tariffs on Chinese electric vehicles this week. A source says the tariffs will quadruple from under 30% to over 100% and will include other key exports, including batteries, solar cells, steel, and aluminum. Biden and his staff have spent recent weeks finalizing the measures, but the plan is seen as largely symbolic as China doesn't rely on U.S. consumers for the targeted sectors. And Amazon, Pfizer, Microsoft, and Morgan Stanley are among the companies poised to boost their presence in France. President Emmanuel Macron will host 180 CEOs and executives for the Choose France Summit. The flagship event, now in its 7th year, is part of a push by Macron's government to attract foreign companies and make France a financial hub for the post-Brexit European Union. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Everyone trying to get up. Who is the next London? Up next, Biden clamping down on Chinese electric vehicles.
The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else.
That's coming up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Earnings season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey folks, we've got Microsoft.
Apple earnings crossing the wire. Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Heading into potentially the fourth straight week of gains on equities as people push back their expectation, yes, bring forward some of the expectations for a Fed rate cut, but also deal with a potential weakening in the consumer. Welcome back. This is Bloomberg Surveillance. We are seeing that lift continue to gain up about 0.2% on the S&P. You could see yields lower by about 2 basis points, 448 on the 10-year. 2-year yields and 10-year yields down about 13, 14 basis points since the end of the week of April 19th, with a question of how much more can they fall, given that inflation has not come in. And we are going to be seeing that key inflation read on Wednesday with CPI, consumer price inflation, given the fact that the Fed is very much focused on this metric, potentially at the expense of a weakening economy. Under surveillance this morning, Biden clamping down on Chinese electric vehicles.
They're not competing. They're cheating. They're cheating. And we've seen the damage here in America. The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else because we're investing in America and American workers again.
Here's the latest. President Biden is set to quadruple tariffs on Chinese-made EVs, setting levies over 100%. This week's announcement will also target batteries, solar cells, steel, and aluminum, according to people familiar with the matter. Bloomberg's Mario Parker joining us now. Mario, what do we know about whether these are announcements of tariffs going into effect now or plans for tariffs at some point down the road?
There'll be plans for tariffs at some point down the road. Some of the details are unclear right now in terms of some of the rates. We know that some of them will be quadrupled, tripled, doubled even. We know that EVs are a prime sector that the president will be targeting as well.
Are there any EVs here currently coming into this country from China?
That's a great question. No. And so largely, a lot of this is symbolic, right? We know the climate, the political tenor toward China right now from both parties. The other part of this is practical. The practical part is to head off some of these imports that could come and flood the market as Biden tries to build out the domestic electric vehicle market here in the U.S.
How much meat is there behind this? There's a question, first of all, you can tariff things that aren't coming into the country, or you could go after places like Mexico in terms of production or parts that are coming from China that might be going into other vehicle manufacturers. How widespread is this net?
It's pretty widespread. I mean, it's targeted toward China, right? The point that you hit on is the point that former President Donald Trump, who's running against Biden, tried to square in on Saturday, saying that, well, China could essentially go around some of these tariffs, build some of these products in Mexico, and then ride the coattails of the USMCA, a trade agreement, in order to still circumvent some of these tariffs. It's unclear right now whether or not that'd be possible.
Is there any pushback from any party right now against the sort of greater industrialization and moving away from any kind of U.S.-Chinese trade ties, even if they actually are happening in the same number, even just through some sort of intermediary company? But is there this sense that there is no voice pushing back against that?
Well, there are some voices in the industry, right, who are dependent on some of these products to come through. That's one point. But the other part is, in this very hyper-polarized Washington, D.C., the consensus consensus that you do see, the rare consensus that you do see, is just a stance toward China, right? Think of the TikTok bill a few weeks ago. You can't get anything, any type of bipartisanship agreement on anything until it comes to some of the geopolitical issues with China.
But this raises a question not just about China, but also just in terms of allies. And if you're trying to focus on U.S. production, you're trying to focus on bringing things home and beefing up the industrial sector, how much is that alienating, say, France, which just had a visit from Xi Jinping saying, hey, our door is open and our things are on sale?
And you see some of this light pressure, right, from the Biden administration on the European allies. You're hearing some rhetoric from Donald Trump on a much more aggressive pressure that he'd put on the European allies should he win a second term. His catchphrase in all of this is essentially, we want to have competition with China worldwide, right? Allies and all, but we don't want to decouple. So he's trying to toe this delicate line, and that's the realization that a lot of the allies are still reliant on China as well.
We're here this week really focused on inflation. Inflation very much at the forefront here in Washington, D.C. as well, with a Financial Times poll coming out showing that about 80% of voters see inflation as really their number one issue and really dampening prospects for Biden if it doesn't come down further. How much do we have a sense about the contribution of tariffs and some of these walls that are going up, how much that will have on inflation?
Well, that's one of the criticisms that the Biden campaign and Democrats lobbed toward Donald Trump's plan to essentially increase tariffs ad hoc around what Donald Trump calls a collar around the country. They're saying that, well, his stance would go a bit too far and add to and further fuel inflation. The Biden administration's stance with all of this is essentially that it's targeted, that it won't hurt American consumers.
This is a very difficult sort of circle to put a peg into, and there's a question here as we go forward. Are there independent analyses that you're trusting? What's your lodestar right now in the spin cycle that we're in, given the fact that everyone's going to use everything as a way to try to say the other guy's wrong and bad, even though it's a very complicated time where it's unclear what the right answers are?
Yeah, well, some of the think tanks, I think, here in Washington, D.C., and then some of the investment banks that we rely on as well with their research reports essentially have some of the more sober views, right? So we haven't seen a whole lot, again, in terms of inflationary pressures that this will put. This is the consensus so far is that largely this is symbolic. To your point earlier, there aren't a lot of Chinese EVs here. This does maybe head it off. That's still kind of political speak. But in terms of just how much this will affect the economy right now, a lot of these things, solar cells, aluminum, steel, EVs, they've already been largely shut out of the market from China.
Although solar, there are some potential caveats, there's potential carve-outs for solar panels. In the U.S., this is something the Biden administration wants to ensure, given the fact that industry members have actually lobbied them and said, we actually need those parts, please. And this is something that's part of the green agenda that Biden has. Do we have a sense of how integral Chinese products are to the Biden agenda of a sort of clean energy plan?
This is the tough part, right? Because his landmark legislation, the Inflation Reduction Act, which essentially seeks to remake the green economy, you're seeing some of the solar industry participants saying, hey, well, some of these components that we need to make some of these solar panels in order to enact this legislation that you've put forth, we actually do need some type of carve-outs and workarounds to allow China to import here.
Do we have a sense of how much of that agenda Donald Trump would unwind if he came into office?
Sounds like all of it, because Donald Trump, I think there's no secret about it. He's not a fan of green energy. Just as recently as Saturday, he was railing about wind farms as well, saying he would sign an executive order on day one to roll back anything that gave incentives to wind farms. He rails against solar. He's more to the traditional carbon-based president should he win a second term.
Love that. Railing against wind farms, or at least the subsidies for them, not just saying, wind farms, down with wind farms. Bloomberg's Mario Parker. Thank you so much for being with us. Coming up, you don't want to miss this, New York Stock Exchange President Lynn Martin coming up to talk about all things initial public offerings, as well as potentially nonstop trading for stocks, is something that everyone has been looking for on a weekend where they're with their kids. Well, you could be trading too. Right now, you are seeing that lift continue up to 0.1%, potentially a fourth straight week of gains if it holds.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. Welcome back. We are in Washington, D.C. Anne-Marie has a wonderful interview with Janet Yellen, Treasury Secretary, coming up later this morning. John is in Paris. He's going to be interviewing David Sullivan of Goldman Sachs. Right now, we are looking at what is going on in markets, which is another potential day of gains following 3 straight weeks of gains. That is the longest advance going back to February as people reset their expectations that bring forward maybe some of those Fed rate cuts that previously have been pushed off, potentially off the table even for 2024. Meanwhile, we are focused very much on what's going on in the tech sector. We've been speaking all morning about semiconductors and some of the industrial complex that the U.S. and its allies have been pumping money to in a competition with China. And what we are looking at next is the iPhone and what they're doing with potentially not only their chip suppliers, we've been hearing about them building their own chips and things of that nature, but how they're going to incorporate artificial intelligence more closely with their phones, given the fact that that has been the next wave of innovation. The next operating system of that iPhone is set to include ChatGPT, with Apple close to a deal with OpenAI to bring artificial intelligence to the company's flagship device. Bloomberg's Alex Webb joining us now for more. And Alex, that's where I wanted to begin, this idea of what exactly does this mean?
Well, it means that if this thing goes through, Apple should be able to compete more readily with Google's operating system for mobile Android, right? Google is very much at the bleeding edge when it comes to artificial intelligence innovations. Apple, to be frank, isn't. And so if everybody in the next few years is really going to be looking for AI capabilities in their smartphone, they need to have some sort of offering, and it looks as though that's going to come from ChatGPT.
This raises this question about what kind of financial arrangement there's going to be, who has the data, how much this is going to be a sort of intricate relationship between the two at a time where Microsoft already has a key investment in OpenAI. I'm losing track of all of the threads here, Alex. Can you help me?
Yeah, so you've got OpenAI, which is very closely aligned with Microsoft. Google has its own captive research arm, Google DeepMind, which is merged with Google Brain. Amazon has a growing relationship with Anthropic AI. Apple is a little bit out of the picture here. Now, the thing that Apple has been trying to do with its AI innovation so far, and there is some AI stuff in your iPhone, is to do it on the device, right? What happens at the moment with OpenAI, with ChatGPT, is that you pose a question, it pings that up to a cloud, the cloud then does all the thinking and issues your response. That's all well and good when you're trying to ask big, complicated questions. You know, write an analysis of today's news as a sonnet. What Apple's perhaps more likely to do is get the real functionality, setting a timer. What's the weather like in New York? And then a follow-up question, which will be able to understand, oh, these are the same question. It should be able to do more of that on the device. It'd be really interesting to see how that pans out. The kicker, of course, to processing this stuff in the cloud, it costs something like 12 cents for every 1,000 words it has to process. That is not nothing. And that's why we haven't really seen these AI chatbots come into everybody's virtual assistants just yet.
And we have seen year-to-date Apple shares down about 5% versus that more than 10% gain for Microsoft, Alphabet, Google up almost 21% year-to-date. So Apple lagging behind. You need to get on the ball. There's a question about also just how big of a shift this is going to be with artificial intelligence in our phones. I mean, does it really transform our lives in this meaningful way? Some people saying that it will be a material shift that will cause people to upgrade and buy phones. Other people saying, if you have a better Siri, is that really a game changer?
I think it's, look, Siri may not be the place that it's really making a big difference. It's in these other parts of your life where, when you're writing a letter, when you're putting together a CV, you might increasingly be getting it to plan your evening for you. I think in a few years' time, we will notice that it is actually relatively well embedded in our lives, and we won't really have noticed. It will have just been a steady evolution to that point. The thing that is quite interesting is you've seen a few small AI-powered devices, the likes of the Humane Pin and the Rabbit. They have not been terribly well received by reviewers. A lot of people have been saying, well, yeah, I can just do most of this with a smartphone already. You already have ChatGPT on smartphones through an app which you pay for. So they are already there. It's just a question of how deeply integrated they are, how much of the other bells and whistles in your smartphone these AIs will have access to and be able to control.
Just quickly, Alex, how much does this set up the conference, the developer conference that a lot of people are watching for in terms of some sort of new innovation being announced?
Yeah, this is really the thing that people are looking for with a great deal of attention, investors and users alike. Worldwide Developer Conference in a few weeks' time. That is where they unveil what's going to be in the next operating system for a phone. And seeing how far they've come in the time, because they've had to accelerate pretty quickly into AI, will be really important, not just for users, but for the stock.
Bloomberg's Alex Webb, thank you so much, as always, for that. Meanwhile, the Financial Times reporting that the New York Stock Exchange is surveying market participants on round-the-clock trading. The survey, coming as a startup backed by Stephen Cohen's Point72 Ventures Fund, is seeking SEC approval to launch the first round-the-clock exchange. Let's head to New York, where Danny Berger is joined by the New York Stock Exchange president, Lynn Martin, to talk about why we all need 24/7 trading in our lives. Danny.
Hi, Lisa. That's right, because, we want to be wrangling the kids and have the ability to trade while we do so. Hi, Lynn. Thank you so much for joining us.
Thanks for having me.
So some others might have opinions about this, but overall, the survey that you've gotten so far, from what you've heard, I know you're still in the middle of it. What have you heard?
So far, what we've heard is there are a lot of things to consider, mainly on the infrastructure side, which is not really a surprise. It's why we sought out to get feedback before something like this was introduced by the SRO community. We wanted to understand all of the pieces of the ecosystem that would need to fit together if we're going to introduce this responsibly. So the feedback so far hasn't really surprised us. There's a lot of parts of the value chain to consider.
So realistically, if you did want to do something like this, how long would it take to actually set up that type of infrastructure?
Well, there's a variety of things that would need to be considered. Most importantly, we would need to talk to our regulators about it, not just us. Our clearinghouse, DTC, would also need to consider that with the regulators to the extent that they would remain open for that 24-hour trading.
It's interesting because there does appear to be demand here. Lisa mentioned Steve Cohen's venture wants to do something like this. Do you have any sense of idea of where that demand is coming from, the type of person that wants to be trading 24/7?
So I don't know that it's really 24 hours a day. I think what has started most of the demand, what's really triggered most of the demand, has been the rise of the ETFs. And if you look at the basket in some of the ETFs, particularly the international ETFs, they're not just securities that are listed on a domestic exchange. So from a risk management standpoint, it would make sense that you would want to manage your risk in the underlying baskets when those domestic markets are open.
Fair enough. Now, Lynn, when it comes to IPOs, we started this year. You and many folks were excited for 2024, that it would be a big year. So many people's hopes have been dashed. I think the volume is somewhere still near a decade's low when it comes to IPO volume. Are you still hopeful for this year?
I absolutely am. And actually, I'm incredibly optimistic given the amount of proceeds that have been raised so far in the markets. $14 billion so far has been raised in the U.S. markets through last Friday. We've had about 25 operating company IPOs on the New York Stock Exchange. That's 2 times the amount of proceeds raised year to date versus last year, and 3 times versus 2022. So the markets are definitely opening up. And what I'm personally excited about is those companies we've welcomed have not just gotten large deals done. Many times they have upsized their deals. They've priced either at the high end or above the range. And then they're seeing that pop, the 20% pop when their stock opens. So it's been a really exciting, particularly Q2, really exciting time where we're seeing about 2 IPOs a week at NYSE.
Well, Reddit is a great example of a company
Absolutely.
that IPO'd, a lot of fanfare around it, but a company like Reddit, it's a mature company. It's a quality company. Investors feel safe with it. Is there room for anything outside of that?
So you have seen some more growth-oriented companies go, but importantly, as you mentioned, they've had a path to profitability. So I think that's really what is getting valued. It's why those companies that either are profitable or have a path to profitability are getting rewarded. You look at a company like Viking, which is the largest IPO of the year. It's a household name. I had so many people say to me, I can't believe this company isn't public already, given that many of us have enjoyed their cruises, whatever the case may be. But then you've also got great companies, emerging companies around cyber, like Rubrik, who just IPO'd on us a couple of weeks ago.
Even with the uptick in demand, Preqin data came out that there's still $3 trillion of money tied up in agent companies that haven't gone public. There still is this impetus to stay private for longer. Are you concerned with, as companies stay private for longer, that they found alternative paths to going public and just that norm that we used to see, it's not going to get back to that?
I'm not really concerned because there is no match for the U.S. capital markets in terms of an efficient form of capital and attaining that capital that you really need to scale your business. Not just from that perspective, but also rewarding employees, democratizing investment, M&A. M&A is a big reason that I hear some of these companies going. They believe that there's a different M&A currency that you get with becoming a public company versus staying private. So I continue to be incredibly optimistic. However, if people are going to be more thoughtful about when they go public. I don't think you're going to see a rush to the public markets like you saw in 2021 for quite some time. But importantly, I think we're out of the 2022, 2023 closed IPO markets.
Is there a chance we get back to that rush, and what needs to be in place for that to happen?
Well, it feels like we have the capacity to have a pretty normal year. If we've raised just over 14 billion to date, in an average year you raise about 45 billion in the public markets, we're not too far off. And based on what we're seeing in our pipeline, I think this could be a pretty close to normal year.
How much of that depends on the Fed cutting? Is that necessary?
I don't think it's necessarily dependent on the Fed cutting. I think people are getting used to this concept of there's a little bit of uncertainty in the markets. The big concern you had over the last 2 years was the hard landing versus soft landing, and I think people feel pretty good about our economy. So I don't know that it matters if the Fed cuts once, not at all, whatever the case may be. But I do think you'll probably see a little bit of a closure of the IPO markets around election time, like you have in any other election year.
Fair enough. And going back to some of the things you mentioned of why the American IPO market remains strong despite some of the wobbles, things like the liquidity, the investor base. It's made it a global destination, but there was this report that Shein, the Chinese fast fashion company, wants to list in London instead of the US because of the regulatory environment. Is that global beacon that the U.S. going to change with the U.S. regulators that are more intent on cracking down in China?
I don't know about that. I mean, I can't really speak to the conversations that a prospect like a Shein has had with our regulators. I do hope that they're able to enter the U.S. markets, but it will be up to our regulators to determine how.
Okay, Lynn, we're going to have to leave it there. Thank you so much for joining. Really great to see you. That is Lynn Martin of the NYSE. Lisa, with that, I'll send it back to you.
Wonderful interview, Danny Berger there with the NYSE president, Lynn Martin, talking about all things IPOs and whether they do get off the ground. Some interesting news from HSBC coming out, making this point that I think is important just moments ago, that with the U.S. CPI in focus, if we get an inline print of about 0.4% of an increase, that will be considered a beat. Inline is the new beat, and you will probably see a rally at risk assets. That's the view from the team led by Max Kettner over at HSBC. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Russian President Vladimir Putin making a surprise change to his defense and security teams. Putin replaced his long-serving defense minister with his former economy aide and first deputy prime minister. The ouster of one of his closest allies may reflect frustration at the failure to defeat Ukraine in a war that was meant to last for days and is now in its third year with hundreds of thousands of Russian troops killed or wounded. Campus protests over the war in Gaza are colliding with college graduation season. Comedian Jerry Seinfeld was the commencement speaker this weekend at Duke University, where about 30 students walked out, chanting Free Palestine and waving flags when he was introduced. But Seinfeld didn't address the protests. A small group of demonstrators also showed up at UC Berkeley's commencement on Saturday, but the university says the protesters left voluntarily and no one was arrested. More schools have threatened student protesters with arrest or expulsion if they don't clear out pro-Palestinian encampments ahead of graduation ceremonies. And Tesla is facing further protests at its factory in Germany, where activists are trying to stop an expansion that would require clearing a large swath of the surrounding forest. Police say at least 16 people were arrested on Friday following actions, including breaking into an airfield, damaging new Tesla vehicles, and blocking a road by the factory. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the U.S. risk of stagflation.
If the definition of stagflation is elevated inflation in an era of slower growth, yeah, that's very possible.
Meanwhile, that is coming up next. We are seeing markets continue with their lift, with HSBC saying that they are expecting the dip in risk assets to be behind us. This is Bloomberg.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close. Welcome to Balance of Power.
This is Bloomberg.
Heading into that key CPI print, the key response is going to be, how does a market react to a CPI print that's expected to continue to have a reacceleration a bit from the final quarter of 2023? However, at least not accelerating more than people previously expected. What we're set up for right now is with gains, with what we hear from Max Kettner at HSBC, more might be in store, up to 0.1%, carrying on and building on the gains throughout the morning at session highs. As people assess the 3 straight weeks of gains we're just coming off, we are seeing yields lower, down about 2 basis points, 448 rounded up briefly, a 10-year yield, as people push back the expectation of a Fed rate cut to September, but not necessarily taking them off the table. Under surveillance this morning, the U.S. risk of stagflation.
If the definition of stagflation is elevated inflation in an era of slower growth, yeah, that's very possible. But if you want a definition of stagflation of 5, 6, 7% inflation with contracting growth, that's an extreme definition that I don't think we need to go to just yet.
And that was something that Jay Powell laughed at when he spoke about it at the latest Fed conference. Here is the latest. Treasury yields holding steady ahead of a key week of economic data. James Athey of Marlboro Investment Management saying the CPI print is a big one for the near-term direction of markets, but, quote, it will be broad growth and labor market stats over the next few months, which will have a more fundamental and lasting impact on where markets head next. Last month's reports scream stagflation. And nobody wants that to continue, even if Jay Powell says he doesn't see the stag and he doesn't see the deflation. James joins us now. Congratulations on your new post, James, coming from Aberdeen. I am curious about why you think that the longer-term growth trajectory is going to matter more than inflation at a time where the Fed has said this is a dual mandate and they very much intend to bring inflation back down to 2%.
Yeah, hi, Lisa, and good to be back. Thank you very much. Obviously, the two are interlinked, right? Ultimately, all of the models that sit behind modern central bank thinking tell you that there is some linkage between, growth relative to potential, what that means for the labour market, and ultimately where inflation pressures will be over the policy horizon. So looking at inflation and jobs today is telling you a little more about what was happening in the economy yesterday. So when we see the most real-time stats that try and give us an indication of where the economy is heading with respect to broad growth, that has or should have some signal value for where those key metrics, jobs and inflation, will be in the future. So you can't really disentangle the two unless, and that's where Jim Bianco's definition of stagflation is interesting, unless you get an utter breakdown of the Phillips curve type relationship, and actually stagflation was the description used to describe that situation when it happened in the 70s. And the reason I say nobody wants that is because there are lots of macro environments which are either good for bonds or good for equities. In a stagflation world, it is good for absolutely nothing.
And when you talk about the breakdown of the Phillips curve, it raises this question. All morning we've been talking about industrial policy. We've been talking about the potential for government spending as well as tariffs and blocking off traditional trade routes. Could that in and of itself create a more inflationary pressure than maybe the labor market dynamic would otherwise suggest?
Yes, I mean, the historical analog for that sort of protectionist international trade policy very much goes back to Smoot-Hawley and tariffs, which did create significant problems many years ago. I think deglobalization, just generally, a lot of people would suggest that is a secular inflationary force because it's really the flip side of the global push to outsource manufacturing to the lowest marginal cost region of production, and that has seen the price of these manufactured goods declining pretty steadily over the last 30 years. So absolutely industrial policy will play a part. I think the extent of it, the time horizon over which it occurs is relevant, because to me the question is it an inflationary process, or do we see a step change in the price level which would be different from the point of view of what we experience in the economy, but also what it would mean for monetary policy?
How are you positioning in terms of how this shakes out and where the Fed's reaction function really is in terms of sticky inflation, even with growth that is clearly souring in consumers that are clearly cooling some of their spending?
Yeah, I mean, it won't surprise you too much, Lisa, to hear that I'm on the slightly miserable side of the outlook. That I still believe that we are in an end of cycle dynamic. I'm not a huge fan of the word sticky. It's become, I think, a bit overused. There's a difference between the speed with which disinflationary pressures feed through into various aspects of the consumer price basket and genuinely sticky inflation. I think sticky historically is a word which was more applied to prices. Prices and wages tend to be sticky. That's not the same as sticky inflation. If prices and wages don't change, then inflation will tend to zero. So I think one of the reasons that we haven't seen a really rapid disinflation is because actually economies have held up better than a lot of people, myself included, thought they would. All that we've really seen is a global supply shock that has seen inflation rise and then the flip side of that, inflation come back down. I think as and when, as I expect we will, we see the economy slowing more broadly and we see more significant softening of the labour market, that's when we'll start to see the more cyclical disinflationary pressures. So I still think we're in a world where yields look attractive, duration is attractive, the timing of that's going to be quite difficult. So we are, happy to lean into weakness in the bond market and increase our duration position as we look further into the future and expect the end of cycle to hit more significantly.
Speaking on the slightly miserable side of things, I'm here in Washington, D.C. to host a panel having to do with the deficit and the fiscal overhang of debt. And this has raised a lot of hand-wringing and the deficit concerns about the potential for rates to go up materially higher than you would expect based on inflation and even Fed's rate setting. Do you buy into that idea that we're going to see some sort of bond market disruption in response to profligate spending that doesn't seem to be ending anytime soon?
No, I mean, it is one of those concerns which is out there. I think the problem is that politicians to a pretty significant degree have learnt the wrong lessons, have been given comfort, which is not necessarily something that they should or could rely on far into the future. Obviously, central banks have played a part. They've grown their balance sheets significantly in recent years, and that obviously has taken duration out of the market. That's allowed governments to run deficits which are, much higher than we'd expect given the stage of the cycle. And we saw in the UK that if you push too far, you can just reach that tipping point where other dynamics kick in and things start to look really messy really quickly. The flip side, obviously, is Japan has been apparently on the precipice of that situation for 30 years, and they've never quite reached that tipping point. So it's definitely a risk. It does concern me that there is sort of bipartisan support for having no real fiscal discipline whatsoever. But I suspect that, it's the economy stupid. The economic forces and pressures will ultimately tell for the bond market. And that means that, yes, we're likely to see supply being a constant. But I think, again, as other cyclical assets become less attractive because of how expensive they are and the deterioration in the economic outlook, that should improve the demand picture for bonds commensurately.
James Athey of Marlborough Investment Management, thank you so much. As always, as we look forward to a question of what's going to win out, retail sales that may come in weaker than expected, or CPI, which is expected to come in at 0.4% at a time where the Fed is looking to bring overall annual year-over-year inflation down to 2%. Coming up, Peter Scheer of Academy Securities on how he likes his exceptionalism exceptional. Apollo's Torsten Slok talking about these economic reports as well as the fiscal deficit. And Bloomberg's Sam Fazeli and Sonali Basak. From Washington, D.C., from New York, from Paris, this is Bloomberg.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The consumer clearly is slowing, but I don't think they are collapsing.
You should see some rebalancing in consumer spending. I'd expect a better, sort of more balanced mix to growth going forward.
A lot of people talk about that the consumer is going to slow. What the consumer will do is they will keep spending this cycle.
What's good about the consumer is that there's low unemployment and there's still spending power. What's bad about the consumer is that it's still bifurcated.
Clearly, at some point, you're going to see those defaults pick up.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From Washington, D.C. for our audience worldwide, good morning. This is Bloomberg Surveillance. I'm Lisa Abramowitz. Anne-Marie off to interview Janet Yellen. John off to interview David Solomon of Goldman Sachs. I am here in D.C. to moderate a panel on the fiscal debt because I care about bond auctions. And right now we are setting up for potentially what could be a fourth straight week of gains. We're coming off 3 straight weeks of gains. It is just Monday and it is just open before the trading. But you are seeing those gains continue as people assess the idea of a Federal Reserve that is looking to potentially cut rates sooner than people previously thought in the face of growth that seems to be slowing and a consumer that showed some real questions in terms of consumer sentiment at the end of last week. You can see this S&P futures up 0.25%, extending gains 52.59. Yields marginally lower, but coming back from earlier action where you could see a more significant decline. And this is the push-pull right now in markets. Danny Berger in New York. Really, this to me is one of the key questions. How does the Fed respond given the fact that we are seeing slowing growth? We're seeing a consumer that's clearly running out of power. And yet at the same time, inflation has been sticky with things like rents and car insurance really hanging in there. And some people say lagging behind some of the more current indicators.
Right. Well, things like rent and housing, they've been lagging behind for what, a year and a half? When is this thing finally going to catch up, Lisa? It feels like it isn't. But the reaction function, I think you're right. It is so important because Powell himself set such a high bar. When at the press conference, he laid out the scenario of inflation still above what they want, not seeming to come down. And he said, well, if that all happens, it means that we're less likely to cut. He could have said it means we're going to hike, but he didn't, Lisa, which brings us to this idea. Is this a Powell put? Is the bar really that high to start talking about hikes again?
I love the Powell put is back on the table, given the fact that this is not one Jay Powell that wants to hike rates. We are coming up for a week that really is really landmarked by Wednesday. We get the pair 1-2 punch of both retail sales as well as CPI coming out. The expectation is for a month-over-month read of 0.4%. Just to give you some perspective, you could see a 4.5% annualized pace of CPI in the first 3 months of this year versus 3.3% of an annualized increase in the fourth quarter. That is the acceleration that has people concerned. Meanwhile, we do get a host of Fed speakers today, Mester and Jefferson tomorrow, Jay Powell, and then Kashkari and Bowman coming on Wednesday with a slew of earnings. And this goes to the question, and Danny, you've been really good on this in terms of how much is the consumer pushing back on pricing or absorbing them because they still are able to borrow at a time where card spending, if you look at Bank of America, for example, you are seeing people still spend even on the lower tiers of the income bracket.
Yeah, not even just on cards, but buy now, pay later. People using that has absolutely swelled, which does tend to be the lower income brackets. But Lisa, I really just have this nagging feeling. What happens if retail sales data comes in strong, but we hear from Walmart and Home Depot and they tell us what everyone did earlier a couple weeks ago, that the consumer is weak? It feels like we just keep getting this conflicting data. And what happens if at the end of this week we say we still don't understand where the consumer is?
I have a feeling that's probably a base case, Danny. What we've seen so far, and frankly, something that is pretty typical during changes in cycle where people don't understand exactly where things are headed next, and that noise can be a signal in and of itself. Here's what we have for you coming up today. Peter Scheer of Academy Securities and what he says could be a bumpy landing. Apollo's Torsten Slok ahead of a host of data this week, and expectations the Fed will not cut rates this year, and Bloomberg's Sonali Basak as Archegos' Bill Huang faces life behind bars. What I want to let you know just for the rest of the day, at 10 a.m., we're kicking off an incredible line of coverage with Anne-Marie interviewing Janet Yellen, Treasury Secretary, as we do expect those electric vehicle announcements from the Biden administration potentially tomorrow. We're going to be hearing from the President of France, Emmanuel Macron. John Micklethwaite of Bloomberg will be interviewing him. And then David Solomon, Goldman Sachs Chair and CEO in France, with our own Jonathan Farrow later on this morning, as there is this question of, frankly, U.S. executives as the new ambassadors to the world as they get out and try to navigate some interesting geopolitical crosswinds. We begin with our top story. The S&P 500 looking to build on 3 weeks of gains as investors prepare for a busy week of data. Peter Scheer of Academy Securities writing this: I think we are near the end of the lower yields Fed put rally that has helped stocks creep higher on anemic volumes. Last week, we argued that the market might, quote, gap from no landing to some form of bumpy landing. Peter, I'm pleased to say, joins us right now. It seems like we're at some sort of precipice of narrative shift. Is that kind of how you see it?
Yeah, and I feel we kind of clung to this American exceptionalism too long. The data started turning a couple months ago. You've seen it in the City Economic Surprise Index, which encompasses a fair bit of data. And yet all you heard was American exceptionalism, American exceptionalism, American exceptionalism. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were. And I think that's where we're at right now. And Friday's consumer confidence was certainly a shock to anyone who thought everything's still rosy.
Well, this is the reason why some people are looking at this idea of maybe not Goldilocks, but a landing, which will at least bring the prospect of Fed rate cuts back on the table. Why do you see it as something more pernicious than that this weakness is maybe more entrenched?
One, we've all been asking for the last year and a half, when does the consumer slow down? When does credit card debt, all these things start impending, stopping their spending? I think we're seeing some of that. Again, what I found really striking about consumer confidence on Friday is University of Michigan publishes both by Democrats and those affiliated with Republican Party, and the Democrat Party side went down precipitously as well. It's down below 90. So that struck me. It's, there's this party as we're heading to the election. People seem very depressed on both sides. They're worried. I think that kind of accelerates. We'll get a lot of information about sales. And the big thing to me is equities have already had this Fed put rally. So I think we've priced in a lot of Fed put type narrative. We're not going to get that many cuts, even if they cut.
We were speaking to Cameron Dawson of New Edge earlier this morning, and she said she's actually more interested in retail sales than the CPI print, maybe because of what you're just talking about. Would you agree with that? Is that sort of how you view things?
Yeah, I think there's a decent chance CPI will come in lower than expected. just all the way the calculations are done. We probably get a brief rally both on bonds and stocks on that, but it really comes down to what's going on with the retail, what's going on with consumption, what's going to happen, I think, with trade tariffs, right? If we're going to put on more tariffs on China, how do they respond? And I think we have just started this trade war, and it's accelerating. And what we're going to see is more and more margin pressure as Chinese brands try and compete both in China, but also across the globe, not necessarily in the US. But I think that's where there's going to be margin pressure. There's going to be competition with these Chinese brands. That's not yet priced in at all. And I think tariffs, if we announce this week, will make that more clear to people. Hey, we've got to be aware of this. And it's changing how the world global economy is behaving.
Well, I want to get to that in 1 second. This has been your thesis for a long time that's been really prescient, which is basically this is a glut of goods, and the Chinese government's going to try to flood the rest of the world with stuff that they're overproducing because they structurally have to, because their economy relies on it. It's sort of the new housing market is a new industrial overproduction. Before we get there, though, I want to just have you respond, because you seem in direct opposition to what HSBC's Max Kettner is saying. What he put out this morning, the dip in risk assets is increasingly in the rearview mirror as many major equity indices have reapproached their year-to-date highs, talking again about Goldilocks, that essentially some of these pressures that you're talking about are going to keep the Fed cutting on some sort of trajectory that will allow things to keep chugging along. Why do you think that is going to end at a time where earnings have come in stronger than people expected and companies are displaying a good deal of pricing power and been able to shrug off some of the geopolitical headwinds?
No, I think one big thing that's been helping the stock market is a huge record buyback. So we've seen record buybacks. That's certainly supporting stocks. When you look at it, right, in some of the past week, you saw a little bit of weakness, and then it was overcome during the course of the day with what looked like a lot like just, corporate buying. So I think that's been supportive. I think the valuation questions are still real. How much has AI driven us? Where are we headed on AI? Are we getting the benefit? All those things will start playing out, right? We get NVIDIA earnings next week. So that'll be an important part. So I think the valuations are creeping back high, setting people up for another disappointment. And that's why I think we dropped this 5 to 10%. We got down about 6%. We never got to that 10% level. I think we get there, in the next few weeks or months as this realization sets in. There's still too much hopium out there.
Well, this raises a prospect of what's the catalyst? Is it going to be economic data pointing to a more material slowdown in the consumer? Is the consumer maybe not as significant as people previously thought, which is something that we heard in an interview that Danny Berger did earlier this morning? Or is this really going to come from the geopolitics of the moment, of more tariffs, of widening pressures, of this question of whether companies can sell in China at a time where the gates are going up in the U.S.?
So my base case is that this economic weakness has been helping yields lower. That's been helping stocks. We're going to hit a point in the coming days or weeks where we see more economic weakness and people realize, wow, maybe this isn't so good for the future of the market. And that's when you start rolling over in stocks. And then you've got the geopolitical risk. You've got the made by China theory. You've got the tariffs. All of those things, I think, are almost quote unquote freebies if you're going to be short or underweight this market. I think any of those alone can knock this market down, and you potentially get multiple of those things occurring. So I think we're well set up if you want to be underweight to benefit from that. I still like yields. I think yields do go lower, but stocks are going to start giving up this whole narrative of lower yields is good for stocks and say yields are going lower because this economy is shaky, and maybe even jobs aren't anywhere close to as good as the published data has been.
How much do you see a potential rally in government debt, given some of the hangovers with inflation, given the fact that we are seeing tariffs being put in place, and given the fact that the deficit, which some people worry about, some people shrug off, is continuing to climb?
Yeah, I think at the front end, we should get to 2 cuts this year. Maybe you see price in 3 cuts. I don't think we can get any better than that. And on 10s, I think we can go down to maybe 430. So I kind of have this 430 to 450 range. But as you say, you've got all these other issues. And I've got to admit, over the past couple of weeks, I'm increasingly looking at the commodity market and getting more and more nervous that inflation is actually going to creep up through the commodity market. And that was off my radar, I would say, 2-3 weeks ago. And as you look through the data, you go back through, look, a lot of the ISM, a lot of the PMI, all prices paid were much higher while the rest of the data was weaker. So, I don't want to say stagflation. I don't think that's a realistic situation, but I can't dismiss it as easily now as I could a month ago.
Just real quick, which commodity? Because oil prices haven't been really shooting higher. What are you watching?
So copper's up quite significantly. You've seen gold, the precious metals up, nickel's up. A lot of the industrial metals are actually up. Oil's been fairly stable. Oil had a lot priced in, and it's kind of been calm. again, it hasn't really retreated even as you've seen kind of the status quo emerge in the Middle East. So I think that's still susceptible for a shock. But really, copper's been one of the big keys that I've been looking at.
And with a 5 to 10% decline in equities, Peter, are you a buyer? Is this a buy the dip moment?
Yeah, I think so. I think it'll be a good opportunity. Again, right now, I like foreign stocks better than U.S. stocks, so I'm not completely bearish on the global economy. I like Chinese stocks, Indian stocks, much better than I like, the NASDAQ 100. And I am wanting to buy banks and some of the things that have lagged behind. So some of these low valuation, high debt companies, I think they can rebound as you start getting through this. And we even started seeing in the past week or two, right, where some of the, the Russell 2000 has been doing a little bit better. So I think if we get that pullback, that's where I want to invest. I like the equal weighted indices better, but I am waiting for a pullback to get really committed.
Peter Scheer of Academy Securities, thank you. As always, really wonderful insights. So let's get to an update right now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. President Biden is set to announce heavy new tariffs on Chinese electric vehicles this week. A source says the tariffs will quadruple from under 30% to over 100% and will include other key exports, including batteries, solar cells, steel, and aluminum. Biden and his staff have spent recent weeks finalizing the measures, but the plan is seen as largely symbolic as China doesn't rely on U.S. consumers for the targeted sectors. Donald Trump pledged to double down on tax cuts if he wins a second term as president. Speaking at a rally in New Jersey this weekend, Trump said, quote, "Instead of a Biden tax hike, I'll give you a Trump middle class, upper class, lower class, business class, big tax cut." President Biden has called for tax hikes on businesses and the richest Americans. And Disney's Kingdom of the Planet of the Apes took in $56.5 million to top the domestic box office this weekend. That tops the up to $50 million projected. This marks Disney's first release of a new film in theaters this year. Its other big budget pictures in 2024 include Pixar's Inside Out 2, Marvel's Deadpool and Wolverine, and Moana 2. That's your Bloomberg Brief. Lisa?
What's old is new again. Thank you so much, Yahaira. Up next, the morning calls, plus a look at pharmaceuticals and a possible short squeeze, forcing some traders to bail out. That's next. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. This is Bloomberg Surveillance on a week of inflation and retail sales. Interestingly, a number of guests this morning have said that retail sales more important potentially even than CPI. We could see a lift continue in the equity market after 3 straight weeks of gains, 52, 57, up 0.2%. 10-year yields lower by about a basis point, 4.5% rounded up, 4.48%. What we're looking at in foreign exchange is actually fascinating, and what you are seeing is more volatility in foreign exchange of developed markets, G7 currencies, than emerging markets more consistently for the first time going back to 2017. All eyes very much on the Japanese yen, the dollar bouncing back versus the yen weakening again after a surprise announcement overnight that the Japanese authorities were not going to buy back as many bonds as people previously were expecting, giving a lift to the long end of the yield curve in terms of yields higher to their highest levels going back to 2011. A brief sense of strengthening in the yen, and then boom, that reverses as well as people push back and say, ultimately, how much is this really signal and how much is this noise? Time now for the morning calls. First up, Jefferies keeping a buy on NVIDIA, but boosting its price target to $1,200 from $780. The analyst saying the company maintains control of the entire artificial intelligence ecosystem. Next up, BNP Paribas upgrading Cisco to neutral. The bank seeing limited downside for the networking equipment maker. BNP had the last negative rating on the stock. And finally, JP Morgan upgrading Novavax to neutral from underweight. The analyst citing an agreement with Sanofi to license a combined COVID-19 and flu shot. A 99% surge putting pressure on short sellers. But the stock is still far from its peak during the height of the pandemic. Bloomberg's Sam Fazeli joining us for this story and more. Sam, before we go anywhere, I just want to say, is a COVID-19 and an RSV vaccine and all of these vaccines, are they still considered any kind of benefit to these stocks, or are they basically just hangovers from an era that we're pretty much through?
Yeah, I mean, if you look at it, the enthusiasm by which people were greeting vaccine news, this is a special case, Novavax, but in general has receded a little bit. You've got vaccines that are making a huge difference, significant difference, but the reality is that expectations became so high during the pandemic that, of course, now the reality is hitting, and we're getting a little bit of what we call vaccine fatigue, unfortunately, washing into other vaccines that are absolutely necessary, such as measles, etc. So I think some of that has evaporated for sure.
Just to sort of zoom out, because we were talking about this incredible short squeeze with a 99% gain in these shares, potentially pushing away the doubters and the haters. There's a question of just how much we've seen incredible swings, incredible volatility, incredibly big bets in the biotech sphere. Not like what we've seen going back several years in the face of both Ozempic, or just weight loss drugs, as well as some new potential mRNA or some potential cancer vaccines as well. Sam, can you put this into perspective, how volatile this has been?
Yeah, I mean, the sector's been pretty volatile, including not just biotech, including large pharma. If you look at share price moves after the first quarter, which is what my colleague John Murphy and I talk about as how could it be interesting as you go into it, because it's only 4 or 5 weeks after they just reported 4Q. And it turns out that actually this was quite an interesting and exciting period for the large pharmas and the biotechs. The smaller biotechs continue to be at the mercy of clinical trial readouts. We had one of the big drops over on Friday in Macrogenics, which ended up losing or having a problem with one of his trials, but that is to be expected. These companies are highly reliant on the outcome of one drug or another. In the larger space, of course, obesity still rules, but also if you look at large pharma, the majority beat in the first quarter, both on sales and on earnings per share. So there is, and most of them actually raised guidance, and some still have more room to go. So whether that resulted in a short squeeze or not, you know, you've been talking about that, but in reality, the sector did very, very exciting moves during the first quarter, which is not normally expected.
Is it because we're just taking more drugs, or is it because of innovation?
Well, I would love it to be just because of the innovation, but frankly, good innovation, better drugs lead to more uptake, as long as the system can pay for it and people can pay for it. So, you know, everybody looks at drugs such as Ozempic and Zepbound or Wegovy as obesity or weight loss drugs, which is not the case. If you look at the variety of clinical benefits that they're giving you, cardiovascular, sleep apnea, renal benefits, these are significant to the point that even CMS has started talking about potentially paying for them for Medicare patients based on those outcomes, not weight loss.
I feel like this year has been bifurcated between AI hopes and dreams and the idea that we're all going to be skinny and healthier. Have we really reached some sort of sea change when it comes to healthcare in terms of both making us all thin and wonderful, and also this idea that we might be able to cure cancer with a vaccine? Do we have a sense that there has been some sort of sea change in the medical field, a breakthrough that has led to a new pace of innovation that exceeds what we've seen in the past?
Yeah, so I'm going to dissect what your question into two. Definitely seeing a new pace of innovation. The results of technology, AI and healthcare, are significantly overlapping, and that is helping faster drug development, potentially a better supply chain management, and it's a theme that we're going to be following up quite closely. But the reality also is the biology, understanding of biology has evolved. But let's not forget, biology has had billions, millions, billions of years to evolve, and we're only into understanding it for about 100 years. So there's much more to understand, and whatever we think, whenever we feel like we've reached that stage of, oh yeah, we've got it, you've got to have to assume that that is wrong, and that it will throw another curved ball at you some other way.
So, Sam, before we let you go, there's been this question around distribution of some of these pharmaceuticals. Increasingly, it's online. And we have seen a number of the big pharmacy providers, I'm thinking of Walmart, some of the other drugstores, closing down their healthcare offerings, finding them losing money and moving away from that. How have you heard about that spoken about by some of these pharmaceutical companies, large pharma in particular, in terms of hopes that they could have more ready distribution through some of those outlets?
Yeah, so the issue that some of the pharmacy chains had was more to do with offering healthcare services, maybe some mental health care services or some other versions of healthcare services, rather than what their go-to business is, which is drug distribution and drug sales at the point where individuals get access through a retail supplier, for instance. So that, I don't think, has anything majorly to do with what the pharma companies are doing, which is trying to cut out the middlemen. Now, that's not necessarily pharmacies. That's more the benefit managers, etc. So they want to try and short-circuit that system where a lot of the costs that we talk about in terms of pharmaceutical gets sucked into, and that's not very visible to people. They think it's the pharma companies that are raking the cash in, which of course they are, and hopefully developing new drugs with it. But there's a lot of that money that's lost in the system to people who probably don't need to be there.
Bloomberg Sam Fazeli, thank you so much. What we have right now in markets, the rally does continue. And just to give you some perspective on how far we've come over the past 3 weeks, in those 3 weeks of gains, we've seen about a 5% gain on the S&P 500. We've seen a 7% gain in the NASDAQ. We've seen a 13 basis point fall in 10-year yields and 2-year yields. Coming up next, Torsten Slok of Powell looking ahead to a busy week of U.S. eco data.
40s.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A light day in terms of economic data, but that is just the beginning. We get PPI tomorrow. We get also CPI and retail sales on Wednesday. Right now in markets, you can see that lift continuing after 3 straight weeks of gains, but fading just a touch, up about 0.2% on the S&P. You can see NASDAQ futures up about 0.25% after a 7% rally over the past 3 weeks in big tech stocks. And Russell climbing just a bit more as people price out the potential for a potential September Fed rate cut. Those are chances around 50% currently. In the bond space, you could see very much influencing small cap stocks. Yields lower yet again, about a 14 basis point move over the past 3 weeks or so. 10-year yields 4.48%. 2-year yields 4.84% after just touching 5% a number of weeks ago. 30-year yields 4.63% as we parse through the push-pull of disinflation, a Fed that is patient, and the potential for the debt overhang and sales of U.S. government treasuries to potentially weigh on valuations. In the currency space, you could see the dollar just reasserting itself a bit, but really it has been trading sideways. The euro 107.97 versus the dollar. The action overnight was with the Japanese yen, but that is also retraced as we get back to the weakening trend that we have seen. A busy week of data ahead. Let's head over to New York, where Danny Berger is joined by our very own Michael Bickey. Danny, I'll head it back to you.
Lisa, you've been so great on the flip-flopping of the narrative, depending on how the data comes in. So, Mike, we got to talk about whether or not we're going to get another flip-flop. Let's start with the big one. Let's start with CPI Wednesday. I saw all economists think that will be less than last month.
Well, that's the highlight of the week, definitely. And unfortunately for the Fed, Jay Powell is speaking before CPI comes out. But yeah, we're going to take our direction from what happens with CPI. And after 4 months of having inflation go the wrong way, slightly, but go the wrong way, we're now going to have it, in theory, according to economists, starting to go back the right way. But not a whole lot, but at least in the right direction. I don't think it changes the Fed a whole lot, but you were talking about, do we get volatility? Yeah, we'll get volatility.
Yeah, if there's one thing we know for sure, Mike, it's that there will be volatility. Lisa and I were talking about this idea that rental inflation, housing inflation, for so long people have said it's a lag, it's going to show up in this report. Mike, is the lag finally going to show up in this report?
I would not make a prediction on that. The Fed is hoping so. They don't have a good explanation for why it's not. There are several explanations about the timing of rent increases and things like that. They would also, especially down at 1600 Pennsylvania Avenue, point out that the Europeans don't put housing into their CPI. And so if you took housing out of the U.S. one, we're both at about 2.4%, which would be a whole lot better than what we're showing now.
All right, set us up for retail figures. What are we likely to get?
Well, you tell me. Have you been shopping?
You know, not enough to save what the figures might be, Mike.
That's the problem, because we had a big month last month, and then we are not expected to have seen a big month, only 0.1% gain after 1.1% the month before. Now, this is the period where the numbers get distorted month to month because of the movement of Easter. Easter moves around a lot end of April this year, and so that pushed some spending into April that might have taken place in May that won't show up. And so it's hard to know exactly how it's going to come out, but we'll look at the control numbers, which don't show a very good performance for retail sales, but American consumers have surprised.
Yeah, savings rate, something like 3%. Of course, it's complicated by the fact that we maybe get some more real-time data with Walmart, Home Depot how much do economists look at that and feed it into the overall picture? For example, if retail comes strong and the companies say, actually, the consumer is concerned and we don't have pricing power anymore, what sort of picture does that leave us with?
That's what you have to do, is separate out the results from the forecasts, which is what you do on Wall Street as well. The results don't mean as much because that was 3 months ago, but the forecasts do get incorporated into people's views of what we might see in retail sales. If the retailers are saying we're not expecting sales to be good, then you're on watch for that to be a problem. And the Fed's doing the same thing. Of course, they're always talking to CEOs in their districts. You can imagine Neil Kashkari is on the phone with the Target people quite a bit, and they'll have a pretty good idea of what the companies think is coming.
Okay, Mike, this is my attempt to be controversial. Tell us why we should care about any Fed speak this week when they've all been saying nearly the exact same thing.
Well, truth be told, I can't tell you a whole lot is going to be that important. Jay Powell will be very important tomorrow because he's always very important tomorrow, but he's not likely to say anything new, particularly since he doesn't have the CPI numbers. The rest of them will all kind of line up and sing the same song from the same music, and it'll be just a matter of degree. You had Mickey Bowman last week saying she didn't think they'd cut at all. You had Raphael Bostic saying one cut, and you have others saying maybe we can cut a couple times this year. But really, nobody is talking about when that's going to happen, and so nobody really knows. It's not going to change a whole lot.
Yeah, it certainly feels like we're in no man's land. Mike, thank you so much. And Lisa, I love that from Michael McKee. The only thing we know for certain this week is there will be volatility.
Well, yeah, that seems to be the feeling more broadly. Thank you so much, Danny. Right now, with us here in D.C., we have Torsten Slok, chief economist for Apollo, who's here for the same event that I'm here for. So I'm very glad to see you. I want to start with a question we've been asking all morning, which is more important, the inflation data or the retail sales data?
Well, if you view it from the Fed's dual mandate, which is inflation at 2% and full employment, inflation is probably a little bit more important. And particularly it's important because for the last 3 months, we've seen the annualized change in supercore go up by 8%. We've seen the annualized change in core inflation go up by 4%. So the momentum in inflation in the last 3-4 months has just been moving in the wrong direction. So what's really important about Wednesday's number is whether that momentum continues or whether we're going to see indeed, as Mike and Danny was just talking about, a move lower in inflation.
Why do you think from the Fed's reaction function they care more about that CPI print, which a lot of people, including Austin Goolsbee, have said is a lagging indicator, versus a real weakening in the consumer in a sense that growth is being challenged?
Well, I think the problem for them is that the momentum in inflation has just not been going down for the last several months. And if momentum has been building to the upside, we really need, from a Fed perspective, to see that momentum break. And that's the risk with the numbers this week. Shelter, there's an argument about, well, on the one hand, maybe areas of occupancy rates are looking a bit better, which would argue for shelter inflation to come down. On the other hand, Case-Shiller is now rising at 6-7% at an annual rate. So that means that we're seeing momentum actually building in home prices. So there's different parts of the scale here that are weighing, and we just don't quite know what the shelter inflation data will do. And it has been coming down a lot slower than what anyone expected. And that might still, combined with auto insurance and combined with everything that's going on in the subcomponents, still continue to put some upward pressure on inflation.
So you still see no rate cuts this year?
We still see no rate cuts. And of course, now FOMC members are also beginning to talk about no rate cuts this year. So I do think that it's just becoming more and more difficult. If you put it together in a little spreadsheet, the growth rate that we've seen for the last 30 years for the rest of this year, you will still have inflation at around 3% by the end of the year. You need a really dramatic slowdown in inflation, 0.1 for every single month for the rest of the year to get core PCE inflation back to 2% by the end of the year. So the upward pressure on inflation is just really strong over the next several months.
What we heard from Fed Chair Jay Powell a couple weeks ago is a real indication he wants to cut rates. He is concerned about the strength of the economy. There is clear deterioration there. It seems like the bias has been more on strength than potentially that inflation read. What makes you think that's going to change, given the fact that we do see real pressure that's coming through with initial jobless claims, with consumer confidence, with the fact that people definitely are feeling something that's coming through in the numbers?
Oh, absolutely. And that's why to retail sales, it is also important. It's not that inflation is the only important indicator this week. Retail sales does play a role. What is interesting is if you look at the Bank of America card data, both for debit card and credit cards, it actually showed surprisingly where they show across the income distribution that there was actually a fairly significant bump higher in spending for both low-income, middle-income, and high-income groups in the month of April. So there's a number of different indicators that are pointing in different directions. We do see, to your point, delinquency rates go up, in particular for low-income households that are younger on auto loans and credit cards, and student loans also have been seeing some pressure. But the bottom line still is that let's see what the data gives us, because overall, yes, the latest non-farm payrolls was a little bit weaker. There were two reasons why that was slightly weaker, but the conclusion still is this economy is not falling apart. It is still a fairly solid growth rate that we see over the next several quarters.
We've been talking about the flip-flopping narrative. We had no landing for a lot of this year. It's been flipping and flopping depending on the day, sometimes in the same day. Then we got to Goldilocks, and that seemed to be where everybody was at for about a couple weeks. And then now people are talking about the potential for a hard landing due to economic weakness. It sounds like you don't disagree. It's just later than people expect, and it's not soon enough to keep the Fed from holding rates where they are. Is that correct?
I think that is correct, but I think that the tailwinds to the economy that are still behind us, two things, namely, we still have behind us a very strong tailwind that comes from easy financial conditions. The stock market is up $9 trillion since the November 1 FOMC meeting when the Fed began to talk about rate cuts instead of rate hikes. And on top of that, we also have a tailwind from fiscal spending. We still have strong spending in the pipeline from the CHIPS Act, Inflation Reduction Act, the Infrastructure Act. Those two things, easy financial conditions and easy fiscal policy, which, by the way, is very different from what's going on in Europe, but those things are likely to continue to give us fairly robust data, at least for the next several months, and most likely even all the way through the end of this year.
Stifel just put out commentary that seemed to agree with what we heard from Peter Scheer of Academy Securities earlier. They said the next 500 points for the S&P 500 are going to be down, talking about a 10% correction, similar to what we heard from Peter. Why do you disagree that there is enough ammunition for things to kind of hang in there and even creep higher, even as people really do wake up to real risks that we're seeing with respect to spending?
Well, I think this is a really important question. So the risk from higher for longer is two things. Higher for longer on its own means higher debt servicing costs for companies. That should argue for stocks going down and credit spreads widening. The problem is that the reason for higher for longer is that the economy is good, meaning earnings are good, GDP has been strong. So as a result of that, we should expect stocks to go up. We should expect spreads to tighten. So there's a tug of war between rates higher for longer is hurting, so to speak, in the CFO's office when debt servicing costs are having a negative impact. But if that's happening because the economy is good, I would still expect the economy to do just fine for the next several quarters as a result of the tailwind of the stock market going up, easy financial conditions, tight credit spreads, and also fiscal policies still providing quite a tailwind.
Does that mean that there's going to be a bigger downside on the other side?
That does mean that when we look into 2025, I do think that we'll set ourselves up, because think about the following, exactly as you're saying, Lisa. The fact that we have delinquency rates going up on credit cards and auto loans, even in an economy where everyone has a job, the fact that you have highly levered companies in venture capital, in tech, in growth, enterprise software that are highly indebted and experiencing a lot of problems, that these problems are still here, even in a good economy. That tells you once people do begin to lose their jobs, once the economy does begin to slow down, you already have a lot of distress, including in commercial real estate. There's a lot of office problems, obviously. Imagine what the problems will look like if you finally get the unemployment rate to move higher. So therefore, the sensitivity next year is that we might actually get a risk of a harder landing coming back. But that's not the theme for the next several quarters.
Meanwhile, you keep mentioning the fiscal overhang and how much that's going to be funding things. It is the reason why we're here. We're going to be speaking on a panel talking about the fiscal debt and how much that's really going to be a problem at a time where Steve Eisman came on and said, the deficit people have been worrying for the past 30 years, and they've been wrong and wrong and wrong. Why is it different this time?
Well, because all the literature and all the papers that look at financial crisis and debt crisis, they do show that if you eventually keep on growing your debt levels up, and they just keep rising, and the CBO, the Congressional Budget Office forecast is that we basically go from 100% of GDP debt levels to 200% of GDP debt levels. Ultimately, it does try to stress the system more in terms of three things: what's happening in treasury auctions, what's happening to ratings, meaning sovereign ratings, and what's happening to the term premium. So that's why in financial markets, we should be watching auctions, which we do every week. We should be watching what's happening from the rating agencies. Will we get another sovereign downgrade of the U.S. from some of them? Moody's still has AAA. Fitch has been downgrading in August. So that's really important. And the third thing is the term premium, which you can find on your Bloomberg screen here, has also been trending high in the last 6-9 months. So the stresses are slowly beginning to emerge. So far, most auctions are going fine, but investors should absolutely be keeping an eye on this. This is something that's just a bigger and bigger risk in the background.
You have some incredible statistics in terms of the amount of debt that's going to mature by the government, $8.9 trillion over the next year. You talk about an average 12% of government spending is currently comprised of debt servicing payments. And we're talking about a lot of people who are still dismissing this in terms of a major risk. What do you think could be the catalyst? At what point do you say to people, you know, you can dismiss it until you can't? Is the election something you're watching?
Well, I would say that if you think about this from a corporate perspective, when debt levels go up, for a long time, it doesn't matter in most cases, and certainly it does matter. So the fear you can have, exactly as you're highlighting, that the rollover of existing debt is roughly around $9 trillion. Then on top of that, the budget deficit, in very round numbers, is about $1 trillion for the next many years. So that brings us to $10 trillion. And then, by the way, the Fed is still doing QT, which adds a few more $100 billion. So it brings you to more than $10 trillion that need to be refinanced in the next 12 months. So that's roughly a third of GDP. If we do continue to see more spending, and if we do continue to see budget deficits as far as the CBO continues to forecast, then I do think that investors need to watch very carefully what's going on, again, with auctions, what's going on with rating agencies, are they downgrading the U.S., and finally, what's going on with the term premium, because that's where the stresses in financial markets will first begin to show up.
So put you down as or the deficit, one of those in that camp.
Absolutely.
Dorson Slock of Apollo, thank you so much for joining us. Very much enjoyable to hear your point of view. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Haqqis. Yahaira.
Hi, Lisa. Apple is nearing an agreement with OpenAI to use the startup's ChatGPT features on the iPhone. That's according to people familiar with the matter. The move would be part of a flurry of new AI features that Apple is planning to announce next month. The tech giant also held talks with Alphabet about the company's Gemini chatbot. Those discussions are ongoing but have not led to an agreement. Tesla is facing further protests at its factory in Germany, where activists are trying to stop an expansion that would require clearing part of the surrounding forest. Police say at least 16 people were arrested on Friday following actions, including breaking into an airfield, damaging new Tesla vehicles, and blocking a road by the factory. And campus protests over the war in Gaza are colliding with college graduation season. Comedian Jerry Seinfeld was the commencement speaker this weekend at Duke University, where about 30 students walked out, chanting Free Palestine and waving flags when he was introduced. But Seinfeld didn't address the protests. Meanwhile, Harvard has signaled administrators are losing patience with protesters who have set up tents at Harvard Yard, where a commencement ceremony with more than 30,000 people is scheduled for May 23rd. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, Archegos founder Bill Huang facing life behind bars.
We're very disappointed at this situation. We're taking it very seriously. We're reviewing the different prime brokers relationships as well as the GFO, the family office relationships, reviewing the risk management processes.
That's coming up next. You're watching Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
About 41 minutes until the start of the trading day, we can see that stocks want to rally further after 3 straight weeks of gains, up about 0.25% on the S&P. It's where they've been all morning. It's no drama this morning. You can see yields lower a bit more so, down almost 3 basis points to 447. Looking ahead to Jay Powell tomorrow, and then, of course, to PPI tomorrow, as well as CPI and retail sales on Wednesday. Under surveillance this morning, Archegos founder Bill Hwang facing life behind bars.
We're very disappointed at the situation. We're taking it very seriously. We're reviewing the different prime brokers relationships as well as the GFO, the family office relationships, reviewing the risk management processes as well in order to get the lessons learned out and make sure it doesn't happen again.
Here's the latest opening statements in Bill Hwang's criminal trial starting in New York today. Hwang is facing fraud and market manipulation charges. He'll be tried alongside former Archegos CFO Patrick Halligan. Bloomberg's Sonali Basak joining right now with Danny Berger in New York with the latest. I'll hand it over to you, Danny.
Thanks, Lisa. That's right. We've got Sonali before she needs to head out to a very cold city where she'll be outside of the New York courthouse. So, Sonali, this was 3 years ago, so I think we might need a little bit of a refresher on what these trials, what the charges actually are.
Remember, the trial of Archegos is really surrounded by what the U.S. has brought forward as a racketeering conspiracy, wire fraud, securities fraud. He was sued separately by the SEC as well. But when we think about this trial in particular, a lot of these counts, each of them could be 20 years in prison, potentially life. We don't typically see that, as you know, but it will be a contentious trial as we believe it. We have seen the defense already come forward, starting to fight a lot of these charges put forward to them. What exactly is the prosecution trying to show here? This idea that Bill Hwang and his deputies had looked to defraud market participants by manipulating and affecting securities prices through amassing swaps in those positions, if you remember, large stakes in companies like Viacom, CBS. They're also trying to say that they convinced counterparties to trade with them and provide them credit based on misleading information. So we may hear a lot from counterparties throughout the course of this multi-week trial.
Just hearing you talk about this, Sonali, this is obviously a complicated topic, as many white-collar trials tend to be. What does the jury look like? Are they the types of people who are set up for this sort of thing to understand even the language that the prosecution is going to be using?
I'm glad you asked that because, of course, there was that jury selection process, and there were people in that process who were very familiar with Archegos, one private equity executive even saying, and of course he was not part of the final jury, that a friend had lost money in the course of what happened with Archegos. So the final jury, you do have some people with exposure to the financial system. You have a software engineer from Bank of America, for example, but then you have others like a former train inspector for the New York Department of Transit. You have a former clerk on the New York Stock Exchange. So quite a colorful jury in and of itself, some with some exposure to finance, but even the judge said that for them, this will be a finance 101 course in many ways as they learn about this market.
Probably better than you could get in any classroom, given the topics they're going to be discussing. Sonali, you mentioned what the prosecution is likely to say. What is the defense likely to say to defend?
Well, one important thing here is that did they break the rules in and of itself? If you read the initial indictment, it is pretty interesting here, Danny, because you do have an acknowledgement at the very beginning that this is an opaque market where there were not rules around the disclosure around some of these products. That's one thing. There's another element here. One thing that I think a lot of people in the market are curious about is Credit Suisse's role, the different banks' roles. Remember this idea that some of Credit Suisse's own risk management practices may have been flawed from the beginning, may
may be a point of contention between the defense and the prosecution here. So throughout the course of what we'll see here, remember, 2 of his employees, his former employees at Archegos, have already pled guilty and are expected here to be testifying during some course of the trial. As far as today goes, you have opening arguments, but you may see witnesses being brought forward from the beginning, including somebody who had worked at UBS, who was at the other end of the calls for Archegos. And so we're going to get into it pretty quickly here as the week goes on.
Yeah, because before you came on, Shonali, we were listening to Ralph Hammer speaking in 2021 when he was the CEO of UBS. How things have changed. I mean, you can see it right there that he's not there, but 3 years on, has anything actually changed on Wall Street to prevent something like this from happening again?
I would say marginally, because you did see the SEC, for example, come forward with new rules around swaps. But have they gone far enough? Remember, a lot of those rules were tied to the initial Dodd-Frank post-2008 regulation that just was implemented kind of late. And so the idea that certain of these actions could be perceived as illegal in the first place, that is being addressed. It's been addressed to some degree by the SEC. Now, you did, in the immediate wake of Archegos, remember, Danny, they had so many conversations inside of regulators about whether this would require more disclosure from family office vehicles. And that we have not seen happen. Now, will this trial inspire that conversation to begin again is a major question. The CFTC has looked at it, and so have other regulators. Will that become a bigger issue moving forward?
Shonali, thank you so much for joining us. That is Shonali Bassick. And Lisa, Shonali is going to head down now to the courthouse in New York. A busy day here on Bloomberg TV.
Hopefully with a sweater on underneath her blazer. Thank you so much. And thank you so much, as always, for today, Danny. Coming up later today, do not miss this. Anne-Marie Hordern sitting down with Treasury Secretary Janet Yellen as we prepare to hear from the Biden administration on tariffs on electric vehicles coming from China. Bloomberg's editor-in-chief, John Micklethwaite, interviewing French President Emmanuel Macron at a time where he's being pitched by everyone under the sun. And speaking of which, our own Jonathan Farrow speaking to Goldman Sachs CEO David Solomon for a rare interview as he sits down in France to try to get an upper hand as potentially Paris lobbies to be the next London and the next financial capital of Europe. Coming up tomorrow on Surveillance, Brian Levitt of Invesco, Franklin Templeton CEO Jenny Johnson, former National Economic Council Director Gary Cohn, at a time where very much the focus is on what a budget under the former President Trump would look like in a Trump 2.0 administration, and Chris Marenghi of Gabelli Funds. We do see a lift to markets. People want to feel good in the push-pull of ping-ponging narratives, whether we get that sort of emphasis on retail sales, whether we get it on CPI. That all comes up on Wednesday, with Jay Powell thrown in the mix tomorrow, speaking on a panel. This was Bloomberg Surveillance from Washington, D.C. Have a good day.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, I'm Matt Miller, back at Bloomberg headquarters. The countdown to the open starts right now. Coming up to kick off the week, investors bracing for a critical stretch of economic data. President Biden preparing to quadruple tariffs on China EVs, and meme stock mania continues with GameStop surging ahead of the open. We begin, though, with the big issue, and that is the countdown to CPI.
There is a good chance that we're going to see a number that ends up being neither fish nor fowl. If we get the 0.3% on core CPI, that is excluding food and energy, that would be a little cooler than we saw in the first quarter. The problem is, for me, and when it comes to thinking about the Fed, is they haven't really laid out their methodology for beginning to lower rates.
Joining us now to discuss is HSBC's Dara Mayer and Invesco's Matt Brill. Welcome, gentlemen. Thanks so much for joining us on this Monday morning. Very interesting as we wait for CPI to maybe show inflation cooling off a little bit. I think the core reading last month was 3.8%. We're looking for 3.6%, but it's not enough, is it, Dara, to allow the Fed to start thinking about easing?
They can't pivot again. We've had three upside surprises. That 2 months they ignored. The third month we got the change in rhetoric to say, we're going to be slower to get that confidence that we are in a position to cut rates. I think even if we get a low bowl number this week, it's going to be hard for them to flip back to saying, oh look, we're back. The case is back there for kind of a swift easing. The fact that we heard from Governor Bowman talking about he doesn't think there's going to be a cut at all this year. There's quite a degree of skepticism, I think, on the FOMC. Look, ultimately, I think we get a cut. We're looking for a cut in the second half of this year, but just one. I just don't see the CPI number being enough to change the Fed's perspective. The market changes on a dime. We've seen that like many times this year already. But for the Fed guidance, I think they'll stick with the idea that we've got to be patient.
Yeah, it's not enough to slow down, equities. We had a bang-up morning session on Friday, up to 52 and I think 52.30 something on the S&P 500. And Matt, it hasn't worried issuance at all either, right? We have, I think, the 7th biggest week on record.
Yeah, good morning, Matt. We had an extremely busy week last week in the investment grade market. You had about 45 companies issuing debt, totaling roughly $60 billion. So, I think the companies that are out there, they're saying the market's open. Yes, yields are a lot higher than they used to be, but they're still worried about that you could get another large CPI print this week. Don't forget, we've got the undercard of the PPI print tomorrow as well. So, I think companies wanted to get the get the money in, get it done with, just in case if you see a print like you saw last month where we saw rates up basically about 15 basis points across the curve when we missed so badly on CPI last month. So hopefully we're not going to get that this month, but I think companies just want to make sure that that was not on the table.
Matt, what are companies doing as far as maturities? Because I feel like a CFO who thinks we're going to get rate cuts isn't going to issue, any long debt. Are you seeing everybody come out with short issues?
So all the end of last year and the start of this year, all we saw was 3- and 5-year debt maturities being issued. And so it was basically companies saying, we think the Fed is going to cut. We think rates are eventually going to go lower. And we don't want to borrow for 30 years because I always have to point out to people that corporate bonds cannot be prepaid, unlike your mortgage. So they didn't want to issue longer debt. And so we saw very little percentage of that. But over the last, I'd say, month or so, you're starting to see that tick up significantly higher. So you went from around 7% issuance of long-dated maturities to now closer to 17% of longer dated maturities. So I think what it's telling you is that companies are saying we might be in this for longer. Yes, we really don't like paying 5.5%, 6% for 30-year debt, but let's just go ahead and do it because this is kind of the new reality that we might be in going forward. And we're hopeful that that's not the case. But I think if you're a corporation, you kind of have to read the tea leaves that this is no longer going to be the quick fix that you thought it might have been.
I want to get, Dara, before I get over to Mike McKee, to talk about the actual data points that we're waiting for this week. You focus on FX. How does the dollar look? I mean, if we thought we were going to get rate cuts, I would expect weakness, but it doesn't feel that weak, although we hit a peak earlier this year that's a bit higher. Is the dollar going to strengthen up if we get expectations for a hike?
Look, I think the dollar is like a long-distance runner at the moment. It's hit the wall a while back. We've had a big repricing already of Fed cut expectations. As you mentioned at the top of the show, equity markets are doing better again. Not great for a safe haven like the dollar. So a few of the elements that had been helping the dollar are looking less supportive. But ultimately, we come back to the yield story. And if yields remain elevated, whether that's given another boost by the data or not, we will see. But if they remain elevated, and they are generally relative to the rest of G10, that continues to support the dollar. Now, whether it propels the dollar higher is a slightly different, question. We characterize the dollar as likely to remain strong, and that is a slightly different characterization from saying, look, we think the dollar is going to continue to strengthen. So that's how we're viewing it. We're looking, just to put some numbers on it, we're looking for 105 in euro dollar into year end. So not the stuff of legends, but it just shows that we think the dollar will at least hold on to the gains it's posted.
All right, let's get over now to our chief economics correspondent. Mike McKee is here with me at 7:31. And Mike, there's a lot of data coming out this week that really matters.
Well, really on Tuesday and Wednesday, Matt. Otherwise, Thursday, Friday, maybe people scoot early for the Hamptons or something because it is inflation week. And tomorrow we get, as Matt said, the undercard of the PPI, which will be important in itself because it'll give us an idea of direction. And the two inflation releases this week are basically going to tell the same story, a slight turn back towards downward momentum in the core. PPI is going to be a little bit higher. Energy's been up. Chair Powell tomorrow is also a major event, but it isn't the kind of event that's going to move markets as it has in the past. He isn't going to really change his view because he hasn't seen CPI yet. That does come on Wednesday. We get CPI and same story where the headline goes up a little bit on a year-over-year basis and the core goes down a little bit on the year-over-year basis. If that happens, then people are going to be happy because it shows maybe we're changing direction and heading in the right direction for a change. If we get a higher than expected CPI print, though, look out for what might happen in the bond market. Retail sales also out. We're expected to be slow, but there are some analysts on Wall Street who think they will be better than forecast. Then we get a lot of Fed speak throughout the week, of course, besides Jay Powell. Now, does it really matter what any of them say? Because they're going to be in the same position as Powell, as not being able to really change their views unless they are speaking after CPI. And Powell is the one who matters. But here's an interesting thing. briefing just a few minutes ago. Philip Jefferson, who is speaking this week and also is the vice chair of the Fed, said this about all the Fed speak. It's a good thing to tell markets what you're going to do, but the potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. So throw that into the mix, and it's going to be an interesting week, especially on trading desks.
Yeah, I mean, a couple of big data points in the economy, but we've had a strong earnings season thus far, and we still get some big numbers out. I think Home Depot is tomorrow, Deere is on Wednesday, Walmart is on Thursday, and of course for Bloomberg Television, we have a lot of key guests, right? Janet Yellen coming up. Mike, what do you expect Yellen to say?
Well, I think she's going to try to stay out of the political fray. She's been criticized for that, but how could you not find out what she thinks about the dollar if she'll tell us? That is going to be really important. And of course, the tariffs that the president's about to put on are a very big story as well. So a lot going on in a very worthwhile interview. Of course, the big event of the week has already happened, and that is your return to work here.
Thank you very much. I'm glad to be back. There's no one crying at the office, so it's a lot easier to deal with than being home with a couple of babies. Mike McKee, our chief economics correspondent, thanks very much for that. Let's get back to Dara Mayer and Matt Brill. Matt, I mentioned earnings, and Bloomberg News reporter Jessica Menton wrote a fantastic story about earnings expectations really being driven up because of the positive results we've seen so far. 90% of S&P 500 companies have already reported. What does this mean for the companies that you cover? What does this mean for credit? You already told us issuance was good. Are they able to keep spreads low?
Yeah, absolutely. There hasn't been a lot of crying in the IG market recently either here. So you've seen good fundamentals. You've seen the earnings coming in, and with earnings coming in and really solidifying the idea that companies are not going anywhere from a pure fundamental standpoint, going anywhere worse from a pure fundamental standpoint. With all-in yields where they are, we're seeing just massive inflows, 25 straight weeks of inflows into the investment grade market, which is driving spreads lower. So until you see any kind of cracks in the fundamental foundation of IG and as well as high yield, you're going to continue to see spreads grind tighter because it's all about yield. It's all about yield. And as yields stay high and there's no defaults or minimal defaults, minimal downgrades, it's an extremely attractive yield market. It's not a very attractive market from a spread standpoint. So we are at our lows on the spreads in both investment grade as well as high yield.
Well, because the economy seems to be doing fine. Dara, how do you see this, globally? I think you just put out your monthly currency outlook. How does the rest of the world look compared to a U.S. that's running on all cylinders? Yes, we had some soft employment data, but otherwise, things are looking up in terms of, GDP estimates are coming up the same way earnings estimates are.
Yeah, very much. Look, the U.S. story has been one of people being upbeat and then being forced to raise their estimates, whether it's raising GDP, lowering unemployment forecasts, and of course, alongside that, they've also been raising their inflation forecasts. I mean, I do think the data points you cite recently, just some softness creeping in. This is a new thing for the U.S., to get downside disappointments and activity. We've not generally had that over the last couple of years. And at the same time, in Europe and elsewhere, we're beginning to get a few upside surprises. Again, a rarity on the activity front. Now, look, the gap is still enormous in terms of relative performance, but it just bear watching. And, talking about those headwinds, the dollar, that relative growth story, in terms of levels, it still favors the U.S., but maybe just in terms of the delta on the data, it's just beginning to be a bit more of a headwind to the dollar at this point.
How does the dollar, Matt, affect issuance in terms of global issuance? I mean, the strong dollar have any effect on the currency people are going out for?
So, what we've seen globally in terms of, generally just hedging costs have been prohibitively expensive. So, that's really more of what most of our investors actually hedge the currency. They don't take it on straight. And you've seen particularly the Japanese investors, it's been extremely expensive for them to buy U.S. investment grade, hedge it back into yen. But the idea is that eventually, as the Fed starts to cut and the Bank of Japan actually increases rates, those hedging costs are going to come down. So there's been that thought that hedging costs will come down. They can lock in yields now and then hedge the cost, have the hedging costs go down later, which would be very good for them. So we've been seeing significant inflows on that notion. You know, if the CPI is not where we need it to be, if you see inflation continue to stay too strong here in the U.S., you know, that will not be good for inflation or for hedging costs down the road, which would then be a negative from overall flows into the investment grade market.
Dara, you look at, I mean, you're focused on FX, but you look at research across asset classes. As we head for another positive open here in the U.S., how does the U.S. equity market look to you?
Look, the backdrop is still constructive. You know, earnings are still doing well. The economy is still doing well. So it's hard to be too bearish on it. I know our team have generally looked for around 5% upside thereabouts on the S&P 500. What I think has been curious, just speaking again, putting on my currency hat, is the relationship between the dollar and equity markets, risk appetite, if you like, historically was very straightforward, inverse. This year, it's been a much more fickle relationship. And so, you know, I'd love to be able to take my cue from equities in terms of driving a currency view, but maybe a bit like your home setup. Yeah, I'm driven to tears trying to work out that relationship at the moment.
Thanks very much for joining us, Dara Mayer and Matt Brill, on this Monday morning. Joining us now with a look at stocks is the aforementioned Jessica Menton, in for Abigail Doolittle. Jess?
Matt, I have to say it's great to have you back in the office. And of course, the S&P 500 is coming off its third weekly gain, and options markets are pricing in a 1% move in either direction on Wednesday post that CPI report. So we have had nearly 90% of the S&P 500 already reporting earnings, but we still have big names this week, like you mentioned, Matt, with Walmart, Home Depot, Cisco, Alibaba, and Take-Two. For this morning's big movers, though, have to start with Apple, ticker symbol AAPL. That stock's up more than 1% after Bloomberg's own Mark Gurman and Julia Love both reported that the company is closing in on an agreement to use OpenAI's technology on the iPhone. Another stock I'm keeping a close eye on is Intel. That stock's also up more than 1%. It's actually gaining after the Wall Street Journal did report that the chip maker is in advanced talks for a deal in which Apollo Global Management that would provide more than $11 billion to help the company build a plant in Ireland. And you know what, Matt? Guess who else is back? Roaring Kitty. If you look at GameStop shares, GME is the ticker symbol on that. If you look heading into the opening bell here, up 44%. So it's poised to have the kind of last surge last seen during, as you remember, Matt, that meme stock mania in the height of 2021. If you look at already going into this month, that stock was up about 57%. So if you look at today's gain and going into that close, it would actually be on pace to potentially beat its monthly gain back in March of 2021, Matt.
Did you see his tweet? Roaring Kitty is, of course, Keith Gill. He's the main figure in the movie The Big Short, I think it's fair to say. And he'd been off social media for a long time, but he had a tweet that was like a guy leaning forward playing a video game.
That's right. It's showing he's still paying attention to what's happening right now. And I have to say, if you look at AMC, that stock's also up in pre-market trading heading into that. That stock's up about 17%. So not just GME, but other meme stocks as well.
Little meme stock mania. We could hear from Bailey Lipschutz.
That's right.
Today.
I think we will.
Covers those. Jess, thanks very much. Jessica Menton there talking to us about stocks ahead of the open. Coming up, President Biden is set to unveil new tariffs on Chinese EVs.
The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else.
The White House preparing to quadruple tariffs on some of China's goods. The details next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
They're not competing. They're cheating. They're cheating. And we've seen the damage here in America. The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else because we're investing in America and American workers again.
President Biden set to quadruple tariffs on Chinese EVs later this week. The White House framing the measures as a defense of American workers. The total tariff on Chinese EVs will rise to over 100% from an already whopping 27.5%. It'll double or triple in other targeted measures. Bloomberg's Craig Trudell joins us now for more. He has covered the auto industry in Detroit, Tokyo, and London, so all around the world. Craig, this is, I think, a fascinating story because, well, at least one car that I've seen out of China, the BYD Seagull, looks really well put together and could be had for as little as $10,000. I think a lot of American families would be happy to get a deal like that.
Yeah, we absolutely could use some cheap Chinese EVs, and yet I think there is real concern in Detroit about them coming into the U.S., and particularly among the American car worker. And I think that's a big part of what's going on here. We heard Biden, say, coming off of the break, that this is a matter of cheating versus competing. It's fascinating that we're seeing much of the rest of the world try to some degree replicate China's attempt to subsidize its way to a more competitive car industry. I think the issue is that China got off to such a head start over the rest of the world that in order to play catch up, the sort of terms of competition are going to have to change, and it is already the case that, to your point, 27.5% is absolutely whopping. Car companies don't operate with those sorts of margins, so this is largely symbolic. This is a case where the U.S. was already close to these companies to the extent that there was even just a sliver of opening. Biden wants to shut that completely.
Yeah, the thing is, I had previously thought of these Chinese products. I mean, leave aside the political, are they cheating or are we being protectionist? I previously thought they were just cheap, shoddy, poorly put together products, but I've been watching a couple of teardowns of BYD vehicles, and they look really well put together. Great quality control, efficient design. I mean, they could compete if we were on a level playing field.
Yeah, I think that was a takeaway that we saw out of the Beijing show just in the last couple of weeks, where you had, some Western journalists able to go to that car show. I think, a combination of the fact that, that COVID led, car shows to go virtual for a while, and then, for some time it was interesting that, it was really difficult to get into China to cover car shows. I felt like there were a lot more Western journalists at Beijing just in the last couple of weeks, and the impressions were really stark, where you had, outlets that really had, nothing but praise to shower on some of these companies. And it's both, being able to actually, make cars that, don't feel flimsy, that do have, a real sort of quality look and feel and material to them. but also the tech offerings. And I think, you know, when you talk about the batteries, not only the cost, but the ability to offer range that is extremely competitive or would be really competitive in the U.S. And also, you know, the fact that the Apples or Google equivalents in China are actually getting into the car business. I think it absolutely is as fascinating a market as it's ever been. And, you know, the inability to sort of, you know, take that and try it out elsewhere in the world is really, you know, for some consumers going to be viewed as a shame.
Well, we're lucky to have you leading our coverage of cars for around the world. Craig, thanks so much for joining us. Bloomberg, Craig Trudell there in London. Stay tuned for more on this because we are going to be talking to Treasury Secretary, U.S. Treasury Secretary Janet Yellen. That's an interview you don't want to miss at 10:15 Eastern this morning. It's 3:15 p.m. London time. Coming up, the morning calls, we're going to tell you which stocks analysts like or dislike. And then later, Kayla Brune of Morning Consult joins us around the opening bell, weighing in on the U.S. consumer as retail earnings start to ramp up this week. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Time now for the morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Bank America downgrading Penn Entertainment to a neutral, pointing to muted Q1 results and a limited market share gain for ESPN Bet. Next up, HSBC naming Delta as its top pick with the U.S. airlines, within the U.S. airlines, highlighting its strong competitive position and increasing demand for international travel. Finally, Cisco losing its only negative rating on Wall Street. So that's when BNP upgrading those shares to a neutral. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we're looking at gains on the S&P 500, NASDAQ, and Russell 2000 futures up almost 1%. Take a look at what's going on in some of the other asset classes that we follow this morning. Of course, you're going to see some currencies there. The euro up against the dollar right now. The 10-year yield down at 446.49, and NYMEX crude up a little more than 0.5% at 78.74 a barrel. But back to the single stock stories that we care about. Alphabet and Apple doing well this morning. Shares of Alphabet are, moving this morning, I should say. Shares of Alphabet are declining as Apple is said to be closing in on an agreement to use OpenAI's technology on its iPhone. Of course, Google is a big challenger to that, or a competitor to OpenAI. Jess Menton is here with more on this battle. Jess?
Well, looking at Apple's stock, up more than 1% right at the opening bell here. And this is a stock that investors have been watching very closely just because it had one of its worst performances relative to the S&P 500 last quarter since the height of the dot-com bubble bust. So looking at this, Apple's actually nearing this deal to use OpenAI on tech on its iPhone. So, of course, Bloomberg's own Mark Gurman, as well as Julia Love, did report this story exclusively for Bloomberg on the terminal. So the company is closing in on this agreement to use OpenAI's technology on the iPhone. If you look over also for stocks like Apple, moving marginally higher as well just after the opening bell. So the two sides, when you are looking at Apple as well as OpenAI, have been finalizing terms for a pact to use ChatGPT features in Apple's upcoming iOS 18 mobile operating system. So you are seeing that stock boosted there. It's still off a little bit more than 7% from that all-time high in December, but nonetheless, it's paring a lot of those losses after it entered a basically a correction back in March, and so now it's back below that 10% drawdown that we did see from that all-time high in December, Matt.
All right, Jess, thanks very much for that. Let's get to another deal. Big headline across the terminal this morning. Intel is in advanced talks with Apollo for a deal that would provide more than $11 billion to help build a plant in Ireland. That, according to the Wall Street Journal. Ed Ludlow has more on that from the West Coast. Ed?
Good morning, Matt. Matt, welcome back.
Thank you, sir.
Intel up a percentage point. It's a big headline, but a relatively muted move. The Wall Street Journal is reporting that Apollo and Intel are in advanced exclusive talks for about $11 billion in financing. And this is for a fab, right, for the foundry business, a build out in Ireland. And it's an extension of kind of what Bloomberg's already reporting, right? Intel has previously done deals with alternative asset managers. It's part of Pat Gelsinger's smart capital strategy, where, as we know, he's like talking with the public sector, looking at government grants and loans, which he's been successful in securing both in Europe and the United States through the CHIPS Act. Then there's the strategic technology partners, and then there's kind of the alternative financing. Bloomberg had reported that Intel had spoken with a number of firms just like this. $11 billion is kind of the middle scale of Intel's ambition. They have an arrangement to invest more than $30 billion in Germany. They are making investments in Israel, and we know about the domestic onshoring of their fab capacity here in the United States. It's the other part of their business that they're trying to build out. Foundry, be a third-party contract manufacturer, and the stock now higher 1.4% for other chip names. The problem is that revenue is going in the wrong direction at that unit, and its losses are widening. So a positive headline, the stock higher, and it's one where we await confirmation in the coming weeks.
They've got to do something, right, Ed? I mean, when I was a kid, and I'm pretty old, Intel was, you couldn't be beat. But they seem to have really missed out on the whole AI thing and haven't been able to catch back up, even after a couple of years' warning.
Gosh, I think that's a pretty accurate summary. Technology leadership on the manufacturing side is them fighting to catch up with TSMC, to be at the cutting edge of nodes for manufacturing. And the AI story, you're right. Intel is still the world's biggest maker of PC chips, processors, but the most lucrative market is high-performance GPUs or combination GPU-CPU AI accelerators that go into data centers or server stacks in data centers, and that's a market they have fallen behind in. If you look at their equivalent product to NVIDIA, Gaudi 3, they'll probably do $500 million of that AI accelerator this year. NVIDIA's going to do what, 40 billion? AMD will do $4.5 billion, so Intel's way off the pace for that lucrative AI accelerator market.
Ed, thanks very much. Ed Ludlow there from Bloomberg Technology. For those watching at home, a PC is like a laptop or a tablet, but it's bigger and clunkier, and you would put it on your desk if you bought one, but you don't. More M&A this Monday. Squarespace has entered into a definitive agreement to go private by Permira in an all-cash transaction valued at approximately $6.9 billion. Isabel Lee is here in the studio with more. Isabel?
Hey, Matt, investors seem to be liking this news. There's a lot of optimism because shares are rising around 13%, which is the most in 14 months. Volume is also surging. So Squarespace is a web design platform that went public in May 2021, and it was valued at that time at around $6.5 billion. And for now, investors are liking this deal because with this deal, investors are going to get $44 per share in cash, representing a 15% premium compared to Friday's close. And this deal is expected to close at around the fourth quarter of this year, and the special committee unanimously approved this and recommended this. So the founder and CEO, Anthony Casalena, is rolling over a substantial majority of his existing equity and will continue to lead as CEO. So this is seen as a huge boost of confidence. He was the founder and founded this company over 20 years ago, and he's still going to be the leader moving forward. So long-term investors like General Atlantic and Axel are also expected to reinvest as part of the agreement. And of course, we have the May 15 Investor Day scheduled, now not in plan. But on May 7, the company reported earnings since Squarespace boosted its revenue for the full year. So that also beat estimates. And for now, shares are still up around 13%.
All right, Isabel, thanks very much. Isabel Lee on Squarespace. Turning now to meme stocks. GameStop is surging once again, this time after a cryptic tweet from Keith Gill, known as Roaring Kitty. Katie Greifeld is here with more on the biggest move we've seen in GameStop since, what, 2021?
That's about right. March 2021, the last time we saw GameStop really rally to this degree. So like you said, Roaring Kitty, his real name is Keith Gill. He played a starring role in the 2021 meme stock mania. He really helped to rally day traders behind the cause of squeezing GameStop short sellers. Remember, GameStop shares, they soared by about 1,600% in January 2021. They're lower by about 80% since that peak. But in any case, Roaring Kitty, he hasn't posted on social media since June 2021. And what everyone is excited about is that yesterday he posted a meme that shows a cartoon man leaning forward with what appears to be a game controller in his hands. As you can hear, I'm doing deep fundamental analysis here. But traders, they seem to be interpreting that as Roaring Kitty is back, whatever that may mean. But that's why GameStop shares are currently higher by about 54%. Like you said, that would be the biggest gain since March 2021. You have the options market lighting up as well. And you take a look at AMC, for example, another meme stock favorite. Shares currently up about 22%, Matt.
GameStop shares are limit up?
There you go.
Limit up?
Limit up.
Triggering a circuit breaker, shares are up 54%, but they currently can't move any higher because of stock market rules. I think we look at a pause and then they'll start trading again. All right, with CPI out tomorrow and retailers like Home Depot and Walmart out with earnings this week, the market's going to get a good look at the state of the U.S. consumer. Joining us now with more on that subject is Kayla Brune. She is a senior economist over at Morning Consult. Kayla, we've already had 90% of S&P 500 earnings out for Q1, and they have done so well that analysts are ratcheting up earnings expectations for Q2 and the rest of the year. So what do you expect from these giant retailers, Home Depot and Walmart?
Well, overall, I think some of the optimism around earnings for some of these companies is really tied to what I would describe as a surprisingly resilient consumer overall in the U.S. We've seen spending hold up. Retail sales went up a little more than expected this month. And in our own data at Morning Consult, we also see stronger spending year over year. I would caution, though, that when we cut our spending data by demographic cuts, we're seeing the gains are not necessarily evenly distributed, and it does seem to be a little bit more the higher income adults that are supporting these top line spending numbers. And it's lower and middle income adults who are maybe being a little more cautious and frugal with their spending. That being said, a retailer like Walmart might still benefit from that. We've seen that before with the inflation surge when we saw a lot of trading down going on with consumers really seeking out that value that actually benefited certain consumers like Walmart. So it could be a bit of a mixed bag for that reason.
How does the U.S. consumer look, Kayla, if you take out, say, the top quintile? If you look at the average American, it seems like credit card debt is strong. Mortgage rates are too high to buy or sell a house because you need to get back in someplace else. Rents are high right now. How does the U.S. consumer look other than, the qualified investor?
Yeah, and those headwinds, I think, are a lot of why we're seeing a little bit of a divergence between higher income adults who also are benefiting from, say, the S&P being up a lot this year so far, whereas middle and lower, sort of that median adult isn't benefiting as much. That being said, the labor market is still pretty strong. Unemployment is so low. So I think that's helping to support, and prevent any sort of collapse for even that kind of average everyday consumer. One measure that we have of this that kind of does give me some, sort of a good reading on the average everyday consumer in Q2. We are coming out this week with, we have this report where we ask the Feds a similar question that the Fed asks on an annual basis about how a consumer would handle an emergency $400 expense. And we actually saw for Q2 that it was the highest level yet would be able to just pay for it with cash since we've been tracking. So that is kind of a positive sign of sort of, it's a little bit of like a pressure test for the consumer budget. How would they be able to handle this expense? And it looks like they're in pretty good shape relative to when we've been tracking over the past year and a half or so.
Maybe they would try and use a buy now, pay later scheme. We had a great story on how it's difficult to measure consumer debt because a lot of consumers are using these kind of schemes to get a product they couldn't otherwise afford. They've already racked up the maximum credit debt or taken as many loans as they can. What do you think about buy now, pay later?
We've definitely been tracking that, and we saw a big surge in usage, and not even just for the groups you'd expect, but high-income adults were really leaned into it over the holidays. We also saw parents have been a pretty big user of that, trying to redistribute costs. Parenthood is expensive. So that is one of those sort of shadow areas where we are seeing some signs of, I don't know if you'd call it strain necessarily, but just a sort of a diversity, a different way that consumers are sort of paying for things and another kind of reading that isn't necessarily going to be captured by those traditional measures. And that has contributed to some uptick that we definitely saw starting in maybe mid-2023 in our data. When we look at sort of the monthly financial obligations ratio for consumers, that increase in buy now, pay later debt, that's still dwarfed by things like credit card debt, but the trend is very sharply upward.
By the way, first of all, I just had my second child, and that kind of triples the cost, so I understand that. I'm locked in my house because I got a great rate before they rose. Is the housing picture kind of a double-edged sword? On the one hand, it's stuck, right? There's no movement. On the other hand, many Americans refinanced at low rates, and so their biggest debt expense isn't that high.
It definitely is a bit of a double-edged sword, and it's the timing of when you did or didn't buy a home is currently playing out as a major differentiator in consumers' finances because, as you said, there's really not a lot of movement. Home sales are definitely suppressed by these higher mortgage rates. At the same time, though, as difficult as it is to buy a home, there has, at least for those who are renters, there's been a large influx in particularly multifamily supply over the past few years. That's where we've largely seen some cooling in the housing market, is with those rent prices. Not so much necessarily because of interest rates, but because of that growing supply. That being said, if we're tying this back to inflation and what we might expect for the shelter component of inflation, we're still seeing a lot of stickiness there. There has not been quite as much cooling as many may have hoped. So the housing market is a big thing to watch for many reasons, both for consumer finances and for the Fed's decision making and how it ties to inflation.
Absolutely. Kayla, thanks so much for joining us. Kayla Brune there, a senior economist at Morning Consult, talking to us about what to expect from retailers, inflation, and housing. Coming up, Archegos founder Bill Wang is in the hot seat.
We're very disappointed at the situation. We're taking it very seriously. We're reviewing the different prime brokers relationships as well as the GFO, the family office relationships, reviewing the risk management processes.
That conversation still ahead on his day in court. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier. Right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Very disappointed at the situation. We're taking it very seriously. We're reviewing the different prime brokers relationship as well as the GFO, the family office relationships, reviewing the risk management processes as well in order to get the lessons learned out and make sure it doesn't happen again.
Opening statements in Bill Wang's criminal trial kicking off in New York this morning. The Archegos founder facing charges of fraud and racketeering conspiracy that could end with a lifelong sentence in prison. Bloomberg's Shonali Bassick joins us now outside the Federal District Courthouse. So, Shonali, what's going to happen and when are we going to see it start?
We should see it start shortly here, Matt. You do have a very busy agenda here in white-collar crime at the Southern District. Of course, we saw FTX, really the trial be pursued just really months ago over here as well. We expect opening arguments, but we also could see a witness called to the stand as early as today. It's likely that the first witness could be somebody who is a counterparty over at UBS. Of course, what we know the prosecution is trying to bring forth is a sense of what Bill Hwang and his deputies had told those banks. Part of the initial indictment was this idea that they misled the banks into trading with them as well as extending a lot of credit in the way that they extended the swaps agreements as well to amass massive positions, ultimately growing that securities portfolio to $160 billion before failing and ultimately causing billions worth of harm to major banks. So we will hear from counterparties. Of course, we know a lot about the jury as well, Matt. This idea that some of them do have some experience in finance, but many, of course, do not. That was a very intentional part of this, making sure that the jury that had been selected did not have personal contacts, for example, who had exposure to some of the stocks that Bill Hwang and his family office had traded and, of course, lost money in regard to. And so, of course, this will be a multi-week trial. And, of course, we know that Bill Hwang defends himself or intends to defend himself vigorously, and that a lot of what he traded did not require disclosure to begin with. So it'll certainly be an interesting trial, multi-week trial, but today we just get started.
We were hearing, we heard a couple of times this hour from previous interviews with Ralph Hamers. You are, of course, our chief Wall Street correspondent, Shonali. How many banks did this blow-up touch? Remind us, you know, what kind of devastation Wall Street saw because of Bill Wang and Archegos, and how much have they really clamped down on controls to make sure something like that doesn't happen again?
Fairly meaningfully, and not just the banks. Remember, regulators as well. But I've got to say, Matt, one thing to me that's the most interesting about what happened after Archegos is you had the SEC and the CFTC in particular really look at disclosures around swaps, because remember, that's how these positions were amassed. They also, the regulators, tried to initially say that this would require family offices to have more disclosure around their holdings, and that part never really happened. We never really saw that type of disclosure. One major question that is kind of burning in the minds of investors is, remember how many hedge funds have converted into family offices in recent years? Well, they still require more disclosure. Will this trial really bring that debate back to surface? Especially because we know, to your point here, Credit Suisse, Morgan Stanley, Nomura, Credit Suisse lost billions of dollars off of this. Morgan Stanley, hundreds of millions of dollars. These were real losses at the end of the day, and some of the rules have not changed.
All right, Shanali, thanks very much. Shanali Basak there, Chief Wall Street correspondent outside the federal courthouse in Lower Manhattan. Now let's get back to the stock market story. For some of the sector price action this morning, we go back to Bloomberg's Jess Menton. Jess?
Looking at the S&P 500, sitting just about 0.5% away from its record last reached at the end of March. If you look on a sector basis in the industry groups here, real estate and utilities are the ones that are driving things higher. Of course, utilities has been on a tear, up 14% in the past 19 sessions. If you look at the opposite end of that, communication services, the lone laggard here, down more than 1.5%. A lot of that is driven by the weights when it comes to Alphabet as well as Meta. Of course, don't forget the Dow. It's still marching toward 40,000. It's been 869 trading sessions through Friday since the Dow first crossed 30,000. So looking to see when that could potentially happen. Now looking at more of some industry groups here beyond just this, the Golden Dragon Index is showing an impressive rise this morning, up about 3% today and up over 9% this month alone. Alibaba is not surprisingly leading the advance here because they do report earnings tomorrow. The U.S. listed shares of Baba are up more than 4%. There's also some moves here. If you look at Tencent Music, entertainment, also a major contributor to this index. It did post fiscal first quarter revenue that beat consensus estimates. And then you do have JD.com's price targets being raised by Loop Capital Bat.
Wow, 40,000. When I was an intern at Tucker Anthony, we had Dow 6,000 shirts made up. That was back in 1996. Jess, thanks very much for that. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Time now for the trading diary, what you need to be watching today. Treasury Secretary Janet Yellen will join Bloomberg Television at 10:15 a.m. You don't want to miss that interview. And then another blockbuster interview at 10:30. We hear from the CEO of Goldman Sachs, David Solomon. Home Depot earnings are out tomorrow, plus U.S. PPI figures. And finally on Wednesday, the all-important CPI and retail sales. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. A lot of stuff coming up in this hour. Sonali Basak, she's downtown New York City. Bill Huang's Archegos Capital Management. He's the founder there. His trial starts today. We'll have some reporting on that. It doesn't look good. Plus, we're going to have a simulcast with Bloomberg Television. We've got a couple of them in this hour. U.S. Treasury Secretary Janet Yellen speaks with Bloomberg's Anne-Marie Hordern. That'll be coming up around 10:15 Wall Street time. And then at the bottom of the hour, radio and TV simulcast. Again, Goldman Sachs Group Chairman and CEO David Solomon. He speaks with Bloomberg's Jonathan Ferro. I think they're over in Europe somewhere. So there's,
Versailles. It's tough.
Versailles.
It's, from what I think. Yeah, it's tough
I thought it was
stuff.
Cleveland. It's not Cleveland, it's
Unfortunately,
Versailles.
yeah. For us,
right.
it's Versailles.
Very good. All right, Alex Steele, I'm not sure she is logged in, so that's a success story right there. So we'll have it all for you coming up. But first, let's kick things off with Lisa Mateo.
You got into this. Bloomberg Business Flash is brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates for 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. All right, a bit of a lift to the markets. Investors await key economic data out later this week, including PPI tomorrow, CPI, retail sales on Wednesday. Bloomberg Economics says April's consumer price index could be a little better or at least no worse than March, and U.S. retail sales probably moderated over in April. Now, J.P. Morgan Chase's trading desk will investors gearing up for big swings in the S&P 500 following that CPI report. So let's check in with the markets. Right now we have the S&P 500, NASDAQ up about 0.1%. We have the Dow up 0.2%. Over to the bond market, the 2-year yield at 4.83%. That's down 2 basis points. And then we have the 10-year yield at 4.46%. That's down 2 basis points. Checking with commodities, spot gold lower 2,345 an ounce. We have Brent crude $83 a barrel, WTI crude at $79 a barrel. barrel. Over to Bitcoin, up 2% at 62,799. Not much on tap for earnings today, but tomorrow we'll get results from Home Depot, Walmart on Thursday. But I have to point out, GameStop, those shares, crazy right now, up 110%, on track for the best month since March of 2021. Yeah, that follows a cryptic post on X from Keith Gill, who we know as Roaring Kitty. That is your Bloomberg Business Flash. Paul and Alex.
Nothing I don't love about that.
No.
Love everything about it.
Yep, 110%. The stock is, wow, just amazing. I mean, it's got, now it's trading halted, so we'll see what happens.
I mean, that's some serious movement, some serious volatility. The other big story that we're following, as Paul alluded to, happy Monday, everybody, by the way, is Bill Huang's trial on Archegos Capital Management. The real issue, of course, is that the accusation that what the prosecutors are looking at is if he actively lied to the banks that were helping him fund these swaps to bet on basically 10 stocks that came spectacularly crashing down on him in the last few years. Sonali Basak is Bloomberg television anchor, and she is joining us outside the New York City Federal District Courthouse. Sonali, what's at stake in this trial?
Well, there's a lot at stake for Bill Huang and, of course, his chief financial officer, Patrick Halligan, who were being accused here by regulators and, of course, the Justice Department of manipulating the markets, of racketeering. Wires fraud and securities fraud are, in particular, the charges that they're facing. They could face significant jail time, depending on how this trial goes. Of course, they are planning to defend themselves quite vigorously here. But there's also what happened, right? We know a lot about what happened in the sense of the banks had lost billions of dollars off the heels of this, Alex. But remember, as a family office, there was not required by means of disclosure for Archegos and Bill Huang. In the initial indictment, you did see prosecutors nod to that fact, but said they did lie to the banks and indeed attempt to manipulate the market. So it will be a trial unlike we've really seen before in the world of white-collar crime.
Sonali, the best I can tell from just reading into this story is that Mr. Huang's defense is basically, hey, I'm not responsible for the other side's losses here. They're big boys too. Does that have merit?
That is a fair assessment here. If you think about Credit Suisse in its own right, this is not the only place they've lost significant money tied to a client. You have the banks saying that they were lied to, but you have Bill Huang saying, well, okay, his defense might bring up Credit Suisse's own risk management report outlining its own failures in risk management at this point in time. So we can see that scuffle between the banks and Bill Huang's defense come up in the course of this trial.
Yeah, see, I think that's so interesting because it really is about the banks helping Viacom CBS issue the shares, right? That's one part of investment banking that led to the sell-off, that led to the margin calls, that led to all of this unraveling. So it's like the two sides shouldn't talk to each other, the ones that are working with Bill Huang and the ones that are helping Viacom CBS issue shares. But in this case, they probably should have been able to talk to each other to see what each other was doing.
Yeah, let's go back and talk a little bit about what prompted all of this. It's the idea that he became a family office with an expected $1.5 billion in capital to more than $35 billion in capital in a very short amount of time. And the reason he was able to amass these massive positions was really buying a lot of these shares on swap agreements. And what happened was he had amassed a size so sizable in Viacom CBS that when the banks went on behalf of the company to try to offload or sell more shares on behalf of Viacom, that's when that created pressure on the shares. That's when the banks started to really look at Archegos, how much they were holding, their exposures, and the need for potential margin calls. Interestingly, on Monday, after those opening arguments, we may hear from the first witness for this trial, and it may be a counterparty at UBS that was behind one of those first early calls that really talked through those margin calls and how quickly Archegos would be able to put those up. So what do they know and not know? What do they need to know? And what do they need to know by law? I think that that's the critical part of this discussion here.
Hey, Sonali, just real quickly, what's the timing here? How long will this trial, how long is it expected to last?
It will be weeks. It will be a number of weeks. We are expected to hear not only from two of his former employees, remember 2 of them also already pled guilty, but there could be a list of more than 24 people from counterparties, these banks, that might step forward in the wake of this trial, in the course of this trial.
All right, Shanali Basak, thank you so much for joining us. Shanali Basak, she's downtown at the courthouse. Archegos Capital trial starting today. Could take several weeks. Big dollars involved. A lot of big, important investment banks involved here. But this was certainly the news of,
oh my gosh, it was spectacular. Yeah, and I mean, I've never seen anything like that before in many ways.
And of course, you know, the biggest manifestation is it just contributed, it didn't cause, but it contributed to the demise of Credit Suisse, my former employer. All right, let's talk technology here. Why not? Because technology rules. Mandeep Singh, senior tech analyst for Bloomberg Intelligence, joins us here. Mandeep, I'm looking at some news here about Intel, Apollo, $11 billion deal, Ireland doing... Intel's making some moves here, but I just don't see the market giving Intel much love here vis-a-vis some of the other chip makers like NVIDIA, like AMD.
I mean, right now, the Intel story is still, you know, show me what you can do around catching up to NVIDIA and really what they are doing in terms of bringing manufacturing, chip manufacturing onshore back to the Western world. And look, I think all these partnerships are great. Even the money they got from the CHIPS Act, almost 20% of that $50 billion. So clearly, you know, they are getting the subsidies. Now it's more about what they can deliver in the next 2 to 3 years, because remember, the fabs do take, you know, time to build. And when it comes to advanced node manufacturing, there's a lot of intermittent steps that need to go right. And so I think the fact that Apollo partnered with Intel is another endorsement that long-term Intel does have a play in terms of chip manufacturing onshore. And I think that's what everyone is positioning for.
What is the reality in terms of what gets built? You mentioned that it can take a long time, right? Just that they're saying they're going to provide more than $11 billion in funding. What are the other things that have to fall into place for Intel to actually break ground and hire the people and make the stuff?
Yeah, I mean, look at all the different aspects of the supply chain. The reason why TSMC is so successful in East Asia, there is an ecosystem that they have created around, you know, the suppliers that supply to TSMC. So all that needs to happen here. The question is, what would it take to build that and bring those other companies as well? And I think Intel, being the largest incumbent here, does have that opportunity to modernize some of its own manufacturing as well as influence the suppliers. But really at this point, it's like taking incremental steps and hoping everything else also falls into place. And I think the government support is crucial. So, you know, imagine a Qualcomm or an NVIDIA announcing a partnership with Intel that they will use some of this manufacturing capacity. Now, it seems unlikely at this point of time, but who knows? They also want to diversify their supply chain and their reliance on TSMC. So in the end, if they have to do things in the Western countries, then Intel is probably the only partner left.
All right, Mandeep, we've gone 4 minutes of technology. All right, Mandeep, we've gone 4 minutes of technology talk without talking about Apple. So let's talk about Apple. The stock's up about 1.2% here today after it was reported that the company is closing in on an agreement to use OpenAI's technology on its iPhone. Is this big news?
It is very big news if you think of it from an Alphabet perspective, because they pay almost, you know, $25 billion of traffic acquisition costs to Apple. And the reason they do that is because they generate over 70 to 75 billion in ad revenue from the iOS ecosystem. So the fact that Apple is tinkering with the default search on its phone and it's not going to be Google, I can see it from Apple's standpoint. They don't want over-reliance on Google for everything, search and LLMs and foundational models. So they want to diversify that bet without having to pay Google. I mean, right now, Google is the one who's paying Apple, to be the default. In this case, if they are using an LLM, some would argue, you know, Apple may have to pay OpenAI or Google. And I think by having both of them on the phone, they're diversifying that bet. And Apple likes to do things their own way. So probably OpenAI gives them more customization than Google would.
Okay, so to Paul's point, it's been like now 7 minutes and we haven't talked about NVIDIA, so let's do that. NVIDIA's not reporting until next week, but I say that because on an earnings calendar this week, there's not that much. There is some retail, obviously, we get PPI and CPI, but the real news is gonna be NVIDIA next week. Are you noticing anything in like positioning or what sentiment is? Amy Wu Silverman of RBC Capital Markets, she covers derivatives, was saying there isn't the exuberance in NVIDIA and the options market that we've seen usually in quarters. And I kind of wonder where that sets us up, Mandeep.
I mean, all the data points that we have gotten so far, in fact, on Friday, we got the monthly TSMC number. Everything points towards AI chips ramping up from a foundry perspective. And look, all that suggests that NVIDIA will have another blowout number. Now, the expectations have gone up, and it will be very surprising if they come out and beat and raise by another 30 to 40% as they have done in the last couple of quarters. But I wouldn't be surprised if they have another big blowout, especially for this quarter. The guidance is what is always interesting, but everything points towards insatiable demand. I mean, right now we are still supply constrained when it comes to GPUs, and the pricing power remains intact when it comes to AI servers.
It's still the growth story, AI. Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence, joining us there, giving us a little overview of what's happening in the world of technology. Coming up in just moments, U.S. Treasury Secretary Janet Yellen will speak with Bloomberg's Anne-Marie Horder, and we'll bring that to you. It's a live simulcast with radio and television. How was your Mother's Day?
So if you haven't heard, I'm sort of anti-Mother's Day. I think it's stupid. I think you should love and honor your mother all the time, unless she's terrible, because I don't need a day to do that. And it was lovely. Can you guess what I did?
Lunch, dinner with daughter and mom.
Yes. And also, what do I love to do all the time? I shopped. We went shopping.
Shopped online for sales.
It was great. It was great. It was really fun. It was really wonderful. And dinner was extraordinarily expensive.
That's inflation.
Dude.
I know.
That was crazy.
Yep, exactly. So, I mean, I think that's what everybody was dealing with yesterday. The restaurants were packed. How about that? All right, coming up, let's get the latest on what's happening with our U.S. government fiscal policy. U.S. Treasury Secretary Janet Yellen speaking with Bloomberg's Anne-Marie Horder and getting a sense of kind of where this Treasury is going, where this government's going, what are its priorities as it thinks about continuing to battle against inflation while continuing to support this economy. Let's go to Bloomberg's Anne-Marie Horder. All right, I guess we don't have Anne-Marie Horder, but I tell you, we hit our mark perfectly.
Yeah,
Radio nails it.
Paul crushed it. We can just go ahead and blame TV.
You know, they're stars and they kind of have their own little
here we go.
But let's go right now to Anne-Marie Horder.
Thank you, Katie, and we welcome our TV audience and radio listeners. Here in Virginia, I'm sitting down with Treasury Secretary Janet Yellen. Thank you so much, Madam Secretary, for joining Bloomberg.
Thanks for the invitation.
We're in Stafford County. This is a county that Trump won in 2016, but flipped to Biden in 2020. And you're here to talk about the fiscal agenda that we've seen out of this administration, you're going to highlight this millions of dollars to broadband in rural areas like Virginia. Yet when you look at consumer sentiment, recent on Friday, the Michigan survey, when you look at recent polls, inflation remains top of mind for American voters. How do you get them to potentially look at the way you look at how the economy is working?
Well, the cost of living in many areas is very high, and it is a concern to Americans. And it is President Biden's top priority to do all he can to bring down the cost of living. Why I'm here in Stafford County, though, is it really illustrates one way in which that's going to occur. I'm looking at an area that has been deprived, has had really no access to the internet at all, sufficiently remote part of Virginia, and President Biden has made a commitment that every American household and business should have access to the internet. And funds that were included in the American Rescue Plan that was passed in 2021, and then later the bipartisan infrastructure bill provided substantial funding to make sure that the internet is available everywhere, and that it's also affordable. And what we saw during the pandemic is that access to the internet is critical to education, to jobs, to healthcare. And it's really a critical tool that every family needs to have access to. And so making that available and making sure it's affordable, which is what I'm going to be seeing here today, a project that has succeeded in reaching about 700 households in this area. This is one way in which President Biden's working to lower the cost of living. But there are many other areas as well. Prescription drugs brought down the cost of insulin to $35 a month. Working very hard to bring down the cost of energy. At the same time, we're protecting the environment and bolstering the finances of households by extending the child tax credit and earned income tax credit.
If inflation, though, is still top of mind of Americans today, why then tomorrow, where it's likely expected the Biden administration is going to lift the walls even higher when it comes to Chinese goods, why then raise tariffs?
The president believes that it's critically important for the United States to have a role and a presence in strategic industries like semiconductors and like clean energy that are going to be the foundation of good jobs and national security in the decades ahead. He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
China is big focus going into the election. We hear the former president also talk about how he wants to put a 60% import tariff potentially on all Chinese goods. He also over the weekend was talking about the Trump-era tax cuts that are set to expire next year. Trump over the weekend said Biden will give you a tax hike. If it was up to Trump, it would be a cut on upper, middle, lower, and the business class. Are you envisioning these tax cuts to be extended?
Well, what President Biden has said, and I certainly strongly agree with it, is that we want to make sure that working families earning under $400,000 are not faced with a tax hike. But all of the wealthy individuals and corporations that benefited from the Tax Cut and Jobs Act, where there are provisions that are going to expire. The president, for the sake of working families and tax fairness, believes that the rich and corporations should pay their fair share. And I would say that CBO, the Congressional Budget Office, recently estimated that extending all of the provisions of TCJA would cost $5 trillion over the next decade. And we really do need to be on a fiscally sustainable path. The president has already signed and put into effect $1 trillion of deficit reduction over the next decade, and he's proposed in his 2025 budget an additional $3 trillion worth of deficit reduction. It really is critical that we are on a fiscally sustainable path. So TCJA, the bulk of the benefits went to the wealthy and to corporations. It blew away the deficit. It caused huge increase in the deficit. It promised an investment boom, and we didn't see it.
So should tax revenues be used to lower the deficit?
Yes.
And is that the plan for Biden, or will they go to social programs?
Well, President Biden believes it's important to invest in areas of the economy that will help us grow and create good jobs. And his budget is one that proposes helping working families and undertaking investments that are critical to our future, but also raising taxes on wealthy individuals who he believes are not paying their fair share, and raising taxes on corporations that are doing extremely well. And he would both invest in America and help working families and lower the deficit.
The U.S. at the moment is spending just as much every year at this point on paying off our debt as it is funding our military. Does the U.S. need lower interest rates in order to balance the budget?
Well, we have to take the interest rate path that prevails in the economy as given. The president's budget incorporates the assumption that interest rates will be in line with the projections of private sector forecasters. So there has been an increase in the interest rate path that's assumed, and it's necessary to make sure that we're on a fiscally sustainable path. Of course, the higher interest rate path makes that more difficult, but the president's budget would hold the I see the key metric that summarizes the burden of deficits as being its interest cost. And the president's plan would hold interest cost at historical levels and not allow them to rise above that.
The federal deficit, though, now is at a level we really don't see outside of recessions. Is anyone in Washington seriously concerned about this? Real conversations about bringing debt back to a sustainable path?
Well, as I said, the interest cost of the debt is a good way to measure its burden. Generally, interest rates have been lower in spite of recent increases. They have been lower than they were in past decades. And that means that metrics like the ratio of debt to GDP, we can probably manage and have a fiscally sustainable path with somewhat higher ratio of debt to GDP. But it's important to make sure that the real interest burden of the debt, which is a measure of the burden it's placing our economy, we have to make sure that that stays in historically normal level.
This isn't just a complaint of fiscal hawks either. This is a complaint I heard a lot at the IMF World Bank meetings. A lot of countries are lining up, concerned about the path that the U.S. is on and what also that means for the U.S. dollar. Heard a lot of people reminiscent of the Nixon times say, The U.S., it's our currency, but it's your problem. Is it right in that context, then, that other countries should be intervening?
Well, our position is that major countries like those in the G7, and this has been agreed in the G7, should have market-determined exchange rates. And if intervention occurs, it should be rare, well communicated, and largely to address excessive fluctuations in currencies. That's the system that we essentially have in place, and I think it's worked well. And of course, differences in the stance of monetary policy across countries is a factor that influences the value of exchange rates.
I'm sure this is going to come up on your next trip. You're going to be meeting with your G7 partners in Italy. There have been reports that Japan has intervened twice. You've said it should be communicated, this should be rare, but they actually haven't worked. So why does it matter?
Well, look, I'm not going to comment on a situation in a specific country. I just want to leave it as when there is excessive volatility, it's possible for countries to intervene. It doesn't always work without more fundamental changes in policy, but we believe that should happen very rarely and be communicated to trade partners if it does.
Just on a final point, and in this FX world, you're going to meet your G7 partners. Do you have a currency pair that you watch the most?
I watch certainly the value of the dollar vis-a-vis major currencies like the euro, the yen, the renminbi, but watch currency developments generally.
Excellent. Treasury Secretary Janet Yellen, we thank you so much for your time. That was, of course, U.S. Treasury Secretary Janet Yellen.
All right, Anne-Marie Hordern with Secretary Yellen and talking about U.S. fiscal policy. A lot going on there in Fredericksburg, Virginia, which is kind of right halfway between Washington, D.C. and Richmond. Because when I went to the University of Richmond, drove down I-95, and now you can't even do that because it's like a parking lot from, I'm going to say, Philadelphia to Richmond.
Yes, I had to go from New York to UVA for a wedding or something. Oh my God, forget it. It took like 2 days. So a lot of interesting stuff going on there. Secretary Janet Yellen talking about China in a very large chunk of that interview, saying that their unfair practices do include things like massive subsidies, and the steps, though, should be targeted, not broad-based. This is ahead of news this week that we should get from the Biden administration on increasing tariffs of certain products from China to the U.S., like EVs. It looks like maybe solar manufacturing equipment may be exempt from that, but that sort of sets the stage for us. She did talk about higher interest rates also, and worsening the fiscal challenge. Basically, the higher interest rates are, the more Treasury has to pay, and guess what? Interest payments.
Exactly right. And I mean, you see some of the interest payment calculations coming out of academia and Wall Street. The numbers are rivaling defense in terms of just the debt service for this country. What are we doing? We're going to go talk to Lisa Mateo.
Let's do it.
Lisa Mateo, she's got a Bloomberg Business Flash for it. Lisa, what do you have?
All right, so we have stocks advancing, kicking off the new trading week after the major averages capped a winning week. Small moves and a mixed close on Friday. It also comes ahead of retail sales. CPI reports on Wednesday. So let's get to the stocks. So we have the NASDAQ up 0.2% or 36 points. We have the Dow up about 0.1% or 67 points. The S&P 500 is little change right now. Over to the bond market, the 2-year yield at 4.84%. That's down 2 basis points. The 10-year yield at 4.47%, and that's down 2 basis points. Checking in with commodities, we have spot gold lower, $2,345 an ounce. We have Brent crude, $83 a barrel. WTI crude, $79 a barrel. Checking with Alphabet shares, they are lower, down nearly 3%, about 2.5% right now. After Bloomberg reports Apple is said to be closing in on an agreement to use OpenAI's technology on the iPhone. So you have Apple shares now up about 1.5%. And finally, Intel shares, they are up about 3%. Wall Street Journal reporting nearing a deal with Apollo Global Management for an $11 billion Ireland partnership. That is your Bloomberg Business Flash. Paul and Alex.
All right, Lisa Mateo, thank you so much. We appreciate that. Some stellar direction coming from the other side of the glass tells me that we're going to go world and national news with Mr. John Tucker, which I just can't wait for.
Okay, Paul and Alex.
Where's my Mother's Day gift?
Oh, happy Mother's Day, buddy.
Yeah. My daughter doesn't have to do anything, but you do.
You didn't get a Mother's Day gift?
No.
Not like
I gilded her into a card, but man, she could have cared less.
Well, welcome to parenthood. Anyway, in the news, Donald Trump's former lawyer and fixer, Michael Cohen, on the witness stand in the former president's fraud and conspiracy trial here in New York. Cohen telling the jury this morning he left the law firm where he was working to become special counsel at the Trump Organization back in 2007. As to point out Trump in the courtroom, Cohen stood briefly to get a look at his former boss and identified him as the man in the blue tie. And not far from that courthouse, for the second time in a decade, New Jersey Senator Bob Menendez facing a corruption trial. This one kicking off today with his political career and freedom on the line. More from Bloomberg's Denise Pellegrini.
Prosecutors are expected to invoke images of gold bars and cash. The 70-year-old New Jersey Democrat and his wife accused of accepting bribes from 3 wealthy businessmen in his home state and performing a variety of favors in return, including allegedly meddling in criminal investigations and taking actions benefiting the governments of Egypt and Qatar. Menendez's lawyers say he's stayed within the rules and did nothing illegal. Menendez has optimistically spoken about mounting a re-election campaign this summer if he's acquitted. Denise Pellegrini, Bloomberg Radio.
And Secretary of State Antony Blinken delivering some of the Biden administration's strongest public criticism yet of Israel's conduct of the war in Gaza. Blinken saying that the Israeli tactics have meant a horrible loss of life of innocent civilians, but have failed to neutralize Hamas leaders.
Israel's on the trajectory potentially to inherit an insurgency with many armed Hamas left, or if it leaves, a vacuum filled by chaos, filled by anarchy, and probably refilled by Hamas.
Secretary Blinken speaking on CBS's Face the Nation, heard Sundays right here on Bloomberg. Global news 24 hours a day and whatever you wanted with Bloomberg News Now. I'm John Tucker, and this is Bloomberg Radio.
John, you and I are both New Jersey natives. Nothing says Jersey politics like gold bars and cash. Right?
Yeah.
That's how we roll here in the Garden State.
Delivered under the seat of a car and the side of a jacket, but yeah. It's not the first time, shall we say.
Yeah, we've been down this road before. So
Yeah, I mean,
that's kind of how we do it in Jersey.
I would put cash and gold bars and soup cans under my bed for sure.
Well, there was, you're too young to remember, but Paul and I are veterans of ABSCAN.
Yep.
Where, what was the senator at the time?
Thompson?
No, oh gosh, I forget now.
Yeah, but anyway, it was, we have some history there.
We've been to this rodeo
I got
before.
you. I got you.
This rodeo
Yeah,
before. All
I
right,
kind of
coming
ignored
up,
this rodeo.
Coming up, we're going to hear from Goldman Sachs Group Chairman and CEO David Solomon. He's going to be with Mr. Jonathan Ferro over in Versailles, France.
This is a Choose France summit that Emmanuel Macron, the president, is hosting. And it's basically like, this is why you need to come and invest in the country.
Yeah.
Especially when you have a country like the U.S. throwing money at industries and companies through subsidies to come here. They might argue with that phrasing.
Right.
Other countries, particularly in Europe, are really playing some catch up because they like the sticks versus the carrots in general.
Right. So, I mean, we have some folks over there, Mr. Monahan from Bank of America.